Chapter 1. The Rise of the Hunt Brothers. This chapter explores the backgrounds of Nelson Bunker Hunt and William Herbert Hunt, two Texas oil tycoons whose fortunes set the stage for their audacious plan in the silver market. Learn how their business ventures in oil led to their interest in precious metals and the increasing fears of inflation during the late 1970s. Backgrounds of the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt were not just wealthy, they emerged from a legacy of oil riches that shaped their ambitions. Understanding their early life provides insight into their motivations to venture into the silver market. Early life. Nelson and William were born into a prominent Texas family which influenced their later business decisions. Nelson Bunker Hunt and William Herbert Hunt were born into a distinguished Texas family with deep roots in the oil industry. Their father, H.L. Hunt, was one of the wealthiest oil magnates in America, amassing a fortune through shrewd investments and a relentless work ethic. Growing up in this environment, the brothers were exposed to the complexities of wealth and business from a young age. They learned the value of entrepreneurship and risk-taking as they witnessed their father's successes and challenges in an ever-evolving market. Influenced by their family's legacy, Nelson and William developed an ambition that pushed them beyond mere inheritance. Their upbringing instilled in them both a sense of entitlement and a drive to expand their family's empire. As they navigated the influential circles of Texas, they dreamed of leveraging their family's wealth to impact the commodity market significantly, setting the stage for their future exploits in silver. Family business. The Hunt family's oil empire provided them with significant capital, setting the stage for their future investments. The Hunt family's oil empire was the foundation upon which Nelson and William built their wealth. Their father's entrepreneurial spirit paved the way for their entry into a world driven by capital and opportunity. By the late 1970s, the Hunt brothers inherited vast resources, allowing them to explore various investment avenues without the constraints that typically hold back other entrepreneurs. This substantial financial backing was crucial when they pivoted to silver. With the appetite for risk ingrained from their family values, the brothers sought to channel their resources into commodities that would weather the impending economic storms they anticipated. The interplay of oil profits and market predictions led them to amass silver at an unprecedented scale, showcasing how familial wealth can offer both the groundwork and the courage to pursue bold ventures. Education and influence. Both brothers had strong educational backgrounds and networks that encouraged their ambitions in the finance sector. Education played a pivotal role in shaping the ambitions and strategies of the Hunt brothers. Nelson and William attended prestigious institutions that not only provided them with a solid grounding in economic principles, but also extensive networks of influential contacts. Nelson studied at the University of Texas at Austin and later graduated from the Southern Methodist University, while William pursued education at both the University of Texas and Harvard Business School. Their academic experiences equipped them with the analytical skills necessary to navigate complex financial landscapes, enabling them to assess market trends critically. Moreover, their educational backgrounds fostered relationships with future financiers and industry leaders, which became invaluable as they sought partners and advisors in their silver ventures. This blend of education and connections paved the way for their audacious plans, allowing them to operate confidently in the financial sector. Initial investments. Before turning to silver, the Hunts had diverse interests, including real estate and agriculture. Before their historic plunge into the silver market, the Hunt brothers diversified their investments across several sectors, including real estate and agriculture. Their foray into real estate began with the acquisition of expansive tracts of land in Texas, where they recognized the potential for significant returns amidst a booming housing market. These ventures often reflected their strategic foresight and understanding of economic cycles. Additionally, their interest in agriculture included investments in farming operations and ranching, further illustrating their belief in tangible assets. These varied investments honed their ability to analyze different markets, manage risk, and seek profitable opportunities. This rich tapestry of experience allowed them to make informed decisions as they transitioned towards silver, embodying the entrepreneurial spirit that drives risk-taking in the face of market uncertainties. The economic climate of the 1970s. The late 1970s was a turbulent time economically, marked by high inflation and rising commodity prices. This climate played a vital role in influencing the Hunt brothers' decision to invest in silver. Inflation surged. The U.S. experienced skyrocketing inflation rates, prompting fears about the stability of the dollar. During the late 1970s, the United States faced an alarming economic crisis characterized by soaring inflation rates that reached as high as 14%. This surge was attributed to several factors, including the oil crises of 1973 and 1979, coupled with expansive monetary policies. As prices for everyday goods and services skyrocketed, public trust in the stability of the dollar waned, fostering an atmosphere of uncertainty. The Hunts, like many affluent individuals of that era, became increasingly concerned about the erosion of their wealth due to inflation. Their belief was that physical assets, particularly precious metals, would serve as a bulwark against the diminishing purchasing power of the dollar. In this chaotic economic environment, Bunker and Herbert Hunt saw an opportunity. Silver became not just an investment, but a potential safeguard, leading them to amass vast quantities of it, believing that the price would continue to rise amidst ongoing turmoil. Gold standard fall. The end of the Bretton Woods Agreement in 1971 diminished the dollar's gold backing, leading to uncertainty. The collapse of the Bretton Woods Agreement in 1971 marked a significant turning point in global finance. This system, which had provided a stable framework for international monetary relations through fixed currency exchanges linked to the dollar, effectively ended when the U.S. moved to a fiat currency system. With the dollar no longer convertible to gold, faith in the dollar's intrinsic value began to falter. This shift led investors to question the long-term viability of the dollar itself. In a world where currencies were subject to the whims of governments, precious metals like silver and gold regained their allure as stores of value. The Hunt brothers, capitalizing on this sentiment, aggressively bought physical silver, believing that their extensive purchases could help restore some stability in an increasingly unpredictable financial landscape. Their ambitions were not without risks, as they aimed to reposition silver as a primary safe haven asset. Investment shift. Many investors sought tangible assets like silver and gold as a hedge against inflation. Building alliances, the brothers forged key partnerships and alliances, which helped facilitate their growing silver empire. To fuel their ambitious silver accumulation strategy, the Hunt brothers understood the importance of building strategic alliances. They partnered with influential individuals and institutions, securing financial backing and access to additional resources. These collaborations were essential in navigating the complexities of the commodity trading environment. Their connections within the oil industry also proved advantageous, as they leveraged existing relationships to bolster their operations in the silver market. By aligning with key players, the Hunts not only enhanced their market presence, but also solidified their reputational capital. These alliances contributed significantly to the expansion of their silver empire, demonstrating how partnership dynamics are often pivotal in high-stakes financial ventures. However, such growing networks would also draw scrutiny, prompting regulatory responses to their unprecedented market maneuvers, the rise in silver prices. The campaign waged by the Hunt brothers significantly altered the landscape of silver trading, leading to a meteoric rise in prices. Their actions had far-reaching consequences for both the market and their fortunes. Price surge. By the late 1970s, silver prices soared, jumping from around $6 to nearly $50 an ounce due to the Hunts' ambitious buying. The late 1970s witnessed an extraordinary surge in silver prices, largely orchestrated by the aggressive purchasing strategies of the Hunt brothers. Initially, silver was priced at approximately $6 an ounce, attracting little interest from mainstream investors. However, as Bunker and Herbert Hunt began amassing vast quantities of the metal, their actions propelled prices into the stratosphere, reaching nearly $50 per ounce. This remarkable increase can be attributed to heightened demand and a burgeoning fear of inflation, which drove investors to seek the safety of precious metals. Central to this price surge was the Hunts' ability to create a sense of scarcity in the silver market. As they stockpiled significant amounts, the perceived supply dwindled, prompting more individuals and institutional investors to buy silver as a hedge against economic instability. This panic buying intensified the upward pressure on prices, demonstrating how the actions of a few can disproportionately impact market dynamics, especially in commodity trading. Market impact. Their accumulation of silver led to tight supply conditions, further pushing prices higher as speculators joined in. The strategic accumulation of silver by the Hunt brothers had far-reaching implications for the market, culminating in an environment of constrained supply. As they collected over one-third of the world's privately held silver, the available stock on the market shrank dramatically. This intentional manipulation resulted in heightened awareness and interest among traders. Consequently, speculators rushed in, amplifying the demand for silver and further exacerbating the price increase. Moreover, the Hunts campaign created a feedback loop. As prices rose, news of their silver hoarding spread, enticing more investors to join the fray. The combination of tight supply and increased demand from both strategic investors and speculative traders set the stage for a dramatic escalation in silver prices, showcasing the volatile nature of commodity markets and the potential for manipulation by significant players. public attention, the hunts garnered media attention, raising awareness and excitement around investing in silver. As the dramatic rise in silver prices unfolded, the Hunt brothers became media darlings, capturing public fascination with their bold investment strategy. Headlines chronicled their ambitious efforts to corner the silver market, transforming them into symbols of financial audacity. This publicity not only reinforced their status among wealthier investors, but also catalyzed a broader national conversation about the merits of investing in precious metals. The media attention played a pivotal role in drawing new investors into the silver market, many of whom were initially on the sidelines. Through televised interviews and newspaper articles, the Hunts painted a picture of silver as a safe haven amid rising inflation and economic uncertainty. This newfound excitement translated into increased buying activity, further inflating silver prices and creating an atmosphere of speculation that was mushrooming at an alarming rate. Speculative frenzy, the Hunt brothers' actions prompted speculation, with many new investors entering the silver market, inflating prices further. The Hunt brothers' audacious maneuvering did not go unnoticed, igniting a speculative frenzy that enveloped the silver market. As the price of silver skyrocketed, many savvy investors realized the potential for lucrative gains, prompting an influx of capital into this once-overlooked asset. The Hunts' continuing purchases fueled a perception that silver was not only a viable investment, but a profitable one, drawing legions of new and inexperienced traders eager to ride the wave of rising prices. This speculative rush resulted in a volatile market environment where prices were propelled not just by fundamentals, but also by pure speculation. Investors, driven by fear of missing out, contributed to a cycle of sharply inflating prices, often detached from the actual supply and demand fundamentals of silver. The Hunt brothers, initially seen as market manipulators, inadvertently became catalysts for broader market behavior, highlighting the unpredictable nature of commodity trading and the influence of collective investor psychology. 1 minute left in Chapter 9%. Chapter 2, the silver market landscape. Understanding the silver market in the late 1970s is crucial to grasp the significance of the Hunts' actions. This chapter reviews how silver was viewed as a safe haven in times of economic turmoil and examines the global silver supply dynamics before their intervention. The role of silver in the 1970s economy. During the late 1970s, silver was considered a critical asset amidst economic instability. As inflation surged and the dollar wavered, investors sought refuge in precious metals. Economic turmoil, inflation, and its impact. During the late 1970s, the United States experienced significant economic challenges, marked by soaring inflation rates that peaked at around 13.5% in 1980. This period of inflation drastically reduced the purchasing power of the dollar, instigating widespread fear among investors. As prices rose across the board, confidence in traditional investments waned, prompting a search for alternative assets that could preserve value during economic uncertainty. The oil crisis of the 1970s further exacerbated these conditions, leading to increased energy prices and contributing to overall economic malaise. In this turmoil, investors turned their gaze towards precious metals like silver, seen as a safe haven against the depreciating dollar. This shift in investor sentiment was pivotal, as silver not only gained popularity due to its inherent value, but also because it was perceived as a hedge against further inflation, driving demand significantly upwards. Silver as a hedged the rise in demand. As inflation accelerated, the demand for silver surged significantly. Investors from various sectors recognized silver's potential as a reliable hedge against economic instability. Unlike fiat currencies, which could be printed at will, silver offered tangible value, making it an attractive investment during times of financial uncertainty. The concept of investing in silver as a protective measure grew in popularity, leading to increased purchasing activities. Market dynamics shifted dramatically as the Hunt brothers capitalized on this prevailing sentiment. Their aggressive acquisition of physical silver was not merely a speculative investment, it was part of a broader strategy to secure a stable asset amidst a backdrop of financial chaos. This influx of demand ultimately drove silver prices to unprecedented heights, further indicating the crucial role the metal played during this tumultuous economic period. Historical context, silver's role in financial crises. Silver has historically served as a stabilizing force during financial crises. In the past, economic downturns frequently led investors to revert to precious metals, with silver often regarded as a less expensive alternative to gold. This trend was particularly notable during the Great Depression, when silver prices showed resiliency amid falling stock values. The 1970s were no exception to this trend. With growing concerns about inflation and government fiscal policies, many investors turned to silver as a means of diversification and security. The historical significance of silver as a financial refuge established a strong precedent, increasing its allure during economic downturns. In this context, the Hunt's strategy to accumulate vast quantities of silver was influenced heavily by this historical valuation of the metal, showcasing their belief in its ability to provide safety during an uncertain future. Key players who dominated the silver market. The silver market in the late 1970s was characterized by a range of key players, from mining companies to individual investors. Notably, the Hunt brothers emerged as dominant figures, leveraging their substantial wealth from oil to make bold investments in silver. They aimed to corner the market, accumulating vast quantities of physical silver and influencing prices. However, the market was also populated with other influential stakeholders, including large institutional investors and speculators who recognized the potential for profit amid rising silver prices. This competitive landscape created a volatile environment where prices could fluctuate dramatically based on trading behaviors and market psychology. The Hunt's actions, combined with the responses of other market participants, would shape the trajectory of silver prices, ultimately setting the stage for the dramatic events of Silver Thursday. Dynamics of silver supply. The global silver supply was characterized by a delicate balance between mining production and scrap silver recovery. Understanding these dynamics is vital to comprehend the Hunt's later actions. Sources of silver mining versus recycling. The global silver supply in the late 1970s derived from two primary sources, mining and recycling. Mining accounted for the majority of new silver learning reading speed 10%. The price of silver in the late 1970s was influenced by various factors, including production costs, geopolitical tensions, and speculator activities. Fluctuations in the supply chain often led to abrupt price changes, which the Hunt brothers attempted to exploit through their coordinated buying efforts. As more investors sought safety in physical silver during periods of rising inflation, the demand surged exponentially. This demand volatility created a delicate balance, where any disruption in supply or sudden influx of selling could drastically affect the market. The Hunt's purchasing strategy, while initially successful, also led to a predatory dynamic in the market, where their actions would precipitate regulatory changes and heightened scrutiny from governmental agencies aimed at stabilizing the commodity market. The emotional appeal of silver. The fascination with silver went beyond its economic value. It became a symbol of security and wealth during volatile times, heavily influencing investor behavior. Silver in culture, myths, and symbolism. The allure of silver traverses beyond mere monetary value. It is deeply embedded in cultural mythology and historical symbolism. Many ancient civilizations revered silver, associating it with the moon and its ethereal properties. In various mythologies, silver is seen as a protective metal, believed to ward off evil and misfortune. For example, in medieval Europe, silver was used in religious artifacts, signifying purity and divinity. This deep-rooted cultural significance contributed to the perception of silver as a safe haven asset, especially during periods of economic uncertainty. Investors viewed silver not just as a commodity, but as a symbol of stability amidst fluctuations in financial markets. This perception heightened the demand for silver, effectively intertwining emotional and cultural narratives with market behaviors, which the Hunt brothers leveraged in their ambitious pursuits. Sentiment-driven demand, emotional investment. Investor behavior in the silver market during the late 1970s was profoundly influenced by emotional connections to the metal. As inflation rose and economic stability wavered, silver's image as a reliable store of value resonated particularly well with anxious investors. Many saw silver as a tangible asset that could preserve wealth against the impending threats of a dollar collapse. This emotional investment manifested in heightened demand, pushing prices to unprecedented levels. The Hunts capitalized on this sentiment, recognizing that many investors were not merely buying silver for profit, but rather as a safeguard against economic doom. This understanding of emotional investment dynamics played a crucial role in the brothers' strategy to corner the silver market and bolster their financial ambitions. Psychological aspects of precious metal trading. The psychology behind trading precious metals like silver reveals a complex interplay between rational analysis and emotional impulse. Traders are often influenced by their perceptions of value, risk, and the broader economic context, which can lead to irrational decision-making. In volatile markets, fear and optimism can spiral, affecting pricing and the behavior of investors. During the Hunt brothers venture, this psychological climate was exacerbated by escalating prices and the fear of missing out on potential gains. Thus, even experienced investors became susceptible to emotional highs and lows, leading to decisions that defied fundamental market logic. The Hunts understood this dynamic. leveraging it to bolster their positions and create significant market volatility in pursuit of their goal to monopolize silver. Greed and fear, the twin engines of market behavior. In the realm of financial markets, greed and fear serve as the fundamental drivers of investor behavior. Greed often compels individuals to chase profits and venture into higher risks, while fear can lead to panic selling and hasty decisions. During the late 1970s, as the Hunt brothers initiated their silver buying spree, the market was rife with both sentiments. The rising silver prices, propelled by the Hunts' massive acquisitions, and the widespread perception of silver as a hedge against economic decline, fueled an atmosphere of greed among investors eager to capitalize on the booming market. Conversely, the abrupt actions taken by regulatory bodies on silver Thursday catalyzed fear, leading to a rapid collapse in prices and showcasing how swiftly market sentiment can shift between opposing forces. This oscillation between greed and fear encapsulated the chaotic nature of the silver market at that time. Market mechanisms in silver trading. The trading mechanisms of silver in the late 70s were complex and influenced by various market forces. A look at these mechanisms reveals how easily they could be manipulated. Exchange platforms, how trading happened. In the late 1970s, silver trading primarily occurred on two key platforms, the over-the-counter market and the commodity exchange. The OTC market provided a decentralized avenue facilitating trades without the need for an intermediary, which allowed for direct negotiation between buyers and sellers. This method was prevalent, particularly among large-scale traders and institutional investors. Conversely, COMEX represented a more regulated environment where standardized contracts could be traded. It allowed participants to hedge risks or speculate on price movements. The presence of both platforms created a dynamic trading landscape, highlighting differing trading strategies and objectives. Active trading on both fronts resulted in substantial price fluctuations that could be influenced by external factors, such as geopolitical tensions and economic indicators. Traditional versus futures markets, a comparison. The comparison between traditional silver markets and futures markets is integral to understanding market dynamics. Traditional or spot markets focus primarily on immediate delivery of physical silver, emphasizing actual ownership and direct transactions. In contrast, futures markets allow traders to agree on a price for silver to be delivered at a future date, introducing leverage and speculation into trading. Futures markets amplified trading volumes significantly as they enabled participants to trade on margin, leading to potentially greater profits, but also increased risks. The Hunt strategy heavily leaned on futures trading, allowing them to exert considerable influence over silver prices despite not owning the physical commodity. This volatility in trading mechanisms showcased how the two markets, while distinct, interplayed to affect overall silver pricing. Leverage, a double-edged sword. Leverage in commodity trading, particularly in silver, can serve as a powerful tool for amplifying gains or deepening losses. During the Hunt brothers' foray into the silver market, they employed substantial leverage to magnify their investment impact. This allowed them to control vast quantities of silver while committing relatively small amounts of capital. However, the inherent risks became evident on March 27, 1980, when prices plunged following regulatory changes. The leverage that had once worked in their favor contributed to staggering losses, highlighting how the very strategy that fuels profits can also lead to catastrophic declines. This episode serves as a stark reminder of the importance of risk management in trading, particularly in volatile markets such as silver. Government regulations and their impacts. Government regulations play a pivotal role in shaping market behaviors and protecting economic stability. In the context of silver trading in the late 1970s, the U.S. government took measures to counteract the Hunts' attempts to corner the silver market. This culminated in the implementation of new restrictions on futures trading. These regulatory actions significantly altered the playing field for traders, illustrating an essential reality in commodities trading: the rules can change rapidly and without warning. The Hunts faced unprecedented challenges, as their positioning could no longer sustain the price elevations they had engineered. This encounter between the Hunts and regulatory authorities emphasizes the fragility of market manipulation attempts and the overarching influence of government regulations on financial markets. The Hunts' unique position. The Hunt brothers' entry into the silver market came at a time when their wealth and ambition allowed them to pursue a highly aggressive strategy, challenging the conventional wisdom of the market. Wealth and influence, the Hunts' financial standing. The Hunts' entry into the silver market was significantly bolstered by their substantial wealth derived from the oil fields of Texas. With billions at their disposal, Nelson Bunker Hunt and William Herbert Hunt became formidable financial players, able to influence commodity markets like few others. Their financial standing allowed them to acquire vast quantities of silver, quickly amassing a significant portion of the global supply. In the late 1970s, as inflation soared and global economic uncertainties loomed, the brothers wielded their resources to buy physical silver, effectively cornering the market. This aggressive strategy not only showcased their financial capabilities, but also their unique position in the market. Leveraging their influence, the Hunts could manipulate pricing dynamics and capture attention in a way that would ultimately reshape the landscape of silver trading. A different approach, buying physical silver. What set the Hunt brothers apart from other investors was their commitment to acquiring physical silver rather than engaging in derivative trading or futures contracts. This approach reflected their belief in silver as a tangible asset, a hedge against inflation and currency devaluation. By hoarding physical silver, they aimed to create scarcity, driving prices upward and forcing other market participants to acknowledge their dominance. This strategy of acquiring nearly all available silver raised eyebrows among traders and analysts. While traditional investors often relied on market speculation, the Hunts' focus on accumulating a hard asset positioned them as both innovators and disruptors. Their determination to hold physical silver illustrated a deeper belief in the metal's value as a safe haven, highlighting their unique approach during a time of market volatility. Vision and ambition. The drive behind the Hunt brothers. The vision of the Hunt brothers was fueled by more than just wealth. It was a reflection of their deep-seated ambition to reclaim what they perceived as a secure future amid economic chaos. Their aspiration revolved around the belief that silver would serve as a refuge against the impending collapse of the monetary system. This ambitious venture was not merely a financial pursuit, but also a quest for a lasting legacy. The brothers saw themselves as pioneers, willing to challenge the status quo. Their relentless focus on silver was driven by a conviction that they could transcend traditional investment parameters. By seeking to corner the market, they aimed to not just profit, but also control a critical global resource, embodying the essence of entrepreneurial ambition that often defines successful market interventions. Market perspective, how the Hunts were viewed. The reaction of the financial community to the Hunts' aggressive accumulation of silver was one of both intrigue and skepticism. As they amassed a significant portion of the world's silver supply, many traders and investors began to speculate about the feasibility of their plan. While some viewed the Hunts as visionary risk-takers, others saw their approach as reckless market manipulation. This dual perception reflected a broader tension within the trading community regarding the ethics of cornering a market. Analysts debated if the Hunts were merely savvy investors or operators disrupting the natural market order. Ultimately, their actions prompted regulatory scrutiny, highlighting how powerful players could shift market dynamics and the balance of power within commodity trading, leading to significant changes in trading regulations and practices. Consequences of market manipulation. Market manipulation, particularly in the case of the Hunts, raised serious questions about ethics and regulations in trading. The implications were felt not just by the brothers, but across the entire financial landscape. Understanding market manipulation definitions and examples. Market manipulation involves deliberate actions taken by individuals or groups to artificially influence the price of a security or commodity. In the context of the Hunt silver buying spree, their strategy included accumulating massive quantities of silver futures and physical metal, creating a perception of demand that drove prices sharply upwards. This tactic is often referred to as cornering the market. By holding such significant stakes, the Hunts effectively altered market dynamics, which brought their actions under scrutiny. One classic example of market manipulation is pump and dump, where an individual inflates the price of an asset through misleading statements before selling off at the peak, leaving others with losses. The Hunts' aggressive accumulation of silver shares and physical holdings similarly distorted market behavior, showcasing how a small number of actors could sway global trends. Consequently, these manipulative strategies raise ethical concerns, as they not only jeopardize investor trust, but often lead to severe market corrections that can affect entire economies. Immediate fallout, price volatility, post-intervention. The immediate aftermath of the Hunts market intervention was characterized by extreme price volatility. In early 1980, silver prices soared to nearly $50 per ounce as the Hunts bought large quantities, igniting a speculative frenzy. However, this unsustainable rise led to panic, and on Silver Thursday, March 27, 1980, the market abruptly shifted. The price plummeted, leading to massive sell-offs and turmoil among investors who had been drawn into the silver market by the Hunts' actions. This volatile environment created distrust among market participants and raised questions about the stability of commodities trading. As prices collapsed, many smaller investors faced significant losses, highlighting the dangerous consequences of manipulation. The Hunt strategy not only revealed the potential for price swings, but also instigated a reassessment of how commodities were traded, paving the way for greater caution among traders and investors alike. Long-term implications for investors in the market. The long-term implications of the Hunt's market manipulation extended well beyond immediate financial losses. Among investors, there emerged a heightened wariness of naked speculation and the risks associated with commodity trading. Many individuals lost faith in silver as a reliable store of value, and this skepticism permeated the market for years. The Hunt's tactics also prompted a reevaluation of investment strategies as individuals sought out safer and more stable options amidst fears of similar occurrences. Additionally, this episode led to changes in investor behavior, emphasizing the need for thorough due diligence and the importance of market fundamentals in guiding investment decisions. The collapse of silver prices served as a cautionary tale, reminding investors that a sudden market shift can occur driven by manipulation. The repercussions of Silver Thursday thus not only impacted the Hunts, but shaped the course of the market for generations, impacting trust and investment strategies across commodities. Regulatory changes, how the market adapted to the Hunts' actions. The actions of the Hunts ultimately triggered a wave of regulatory reform aimed at preventing similar market manipulations in the future. In response to the disruptions caused by their buying frenzy, regulatory bodies instituted new rules around trading limits and margin requirements for commodities. These measures sought to decrease the power individuals or groups could exert over market prices, aiming to create a more level playing field for all traders. For example, the Commodity Futures Trading Commission imposed position limits and enhanced reporting requirements for trades to monitor the activities of large players more effectively. This regulatory shift was designed to restore investor confidence and stabilize the market, ensuring that no single entity could influence prices to such an extent again. Overall, the impact of the Hunt's market actions reverberated through trading practices and regulatory frameworks, ultimately aiming to safeguard against future manipulation and protect the integrity of financial markets. Chapter 3, The Hunt Brothers' Plan. This chapter dives into the audacious plans of the Hunt brothers to purchase silver in unprecedented quantities. With inflation and economic uncertainty looming, hear how their vision of owning silver transformed from a concept into a massive financial strategy. The vision of silver ownership. This section outlines the Hunt brothers' initial vision centered around acquiring vast amounts of silver in response to economic fears. It highlights their motivations and the philosophical underpinnings of their strategy. Inflation fears. The Hunts were deeply motivated by the pervasive fear of inflation that gripped the American economy during the late 1970s. They observed how the value of the U.S. dollar was eroding rapidly, largely attributed to expansive fiscal policies and the energy crises that were destabilizing the geopolitical landscape. Their conviction was that traditional investments, such as stocks and bonds, would not provide adequate protection against this ongoing devaluation. In response, the decision to invest heavily in silver became an avenue to safeguard their wealth. They considered silver a tangible asset, unlike fiat currency, which could be manipulated by government policy. Their anxiety regarding inflation ignited a passionate pursuit to accumulate as much silver as possible, thrusting them into the depths of commodity trading on an unprecedented scale. Wealth preservation. The Hunt brothers viewed silver not merely as an investment, but as a crucial strategy for wealth preservation. They believed that physical silver had intrinsic value that would withstand economic instability, making it an ideal hedge against the ravages of inflation. This perspective reflected a broader trend among affluent individuals seeking hard assets that would sustain value over time. By positioning themselves as major players in the silver market, the Hunts aimed to shield their vast fortunes from the uncertainties of paper assets. Their approach underscored a fundamental belief in the necessity of owning tangible commodities, which they believed would retain value even as economic conditions fluctuated, aligning their wealth management strategies with historical precedents of asset preservation. Strategic planning. The plan devised by the Hunt brothers extended far beyond merely purchasing silver. It was an audacious strategy aimed at dominating the silver market itself. They undertook meticulous planning to systematically acquire vast quantities of silver until they became the largest private holders of the commodity. Their strategy involved leveraging their substantial financial resources to engage in aggressive buying tactics. By concentrating their efforts, they believed they could influence silver prices and create a scarcity that would elevate the value of their holdings. This ambition was rooted in a comprehensive understanding of market dynamics, demonstrating their desire not only to protect their wealth, but to control a crucial economic resource. The strategic nature of this endeavor would eventually attract significant attention and scrutiny from both financial markets and regulatory bodies. Philosophical approach. The philosophical underpinnings of the Hunt brothers' strategy were inherently tied to their belief in individual empowerment through ownership. They posited that owning physical silver provided them with greater control over their financial destiny, shielding them from the unpredictable shifts in governmental monetary policies. This conviction stemmed from a deeply ingrained skepticism about traditional financial institutions and their regulation. Their approach to silver ownership was akin to a declaration of independence from prevalent economic systems, emphasizing autonomy amid uncertainty. The brothers believed that a tangible asset like silver would allow them to navigate through economic turmoil while asserting their financial independence, an outlook that resonated with many other investors during a time of dramatic economic change. Building a silver empire. This section explores how the Hunt brothers turned their vision into action, gradually accumulating silver and creating a formidable presence in the market. Acquisition strategy. The Hunt brothers implemented a highly aggressive acquisition strategy, leveraging their wealth amassed from the oil industry. They focused on purchasing physical silver through various channels, including dealers, exchanges, and direct sales, often using the promise of future demand to justify their purchases. Their objective was clear: to build a controlling interest in the silver market. This approach saw them acquiring massive quantities of silver, with reports indicating they bought over 100 million ounces by early 1980. Their wealth allowed them to bypass traditional financial constraints, indulging in an unprecedented scale of commodity trading. This not only accelerated their acquisition efforts, but also stimulated interest from other investors, who began to see silver as a hedge against inflation. Market manipulation. The Hunts' significant buying spree inevitably led to market manipulation, pushing silver prices from $6 to as high as $50 per ounce within a remarkably short time. Their activities attracted the attention of both private investors and institutional traders, who began to speculate on the rising prices. This shift ignited a silver frenzy as more investors joined in, further inflating the market. By cornering a substantial portion of the market, the Hunts unintentionally made themselves a target for scrutiny from regulators and rival traders. Their dominance created a perception of risk, which later became a catalyst for the drastic responses from the market, including the intervention by authorities on a pivotal day known as Silver Thursday. Stockpiling methods. The brothers employed a variety of stockpiling methods to secure their vast silver holdings. Utilizing warehouses and well-guarded facilities across the United States, they optimized their inventory management, ensuring that their investments were both protected and easily accessible. This operational strategy underscored the enormity of their silver empire. They emphasized the need for secure storage, pointing to the physical nature of silver as a commodity. The stockpiling served two purposes. Not only did it affirm their market presence, but it also created a narrative of scarcity that added to the inflated value of silver. However, such practices required significant logistical oversight and capital investment, which ultimately made their approach vulnerable. Risk assessment. Despite their financial prowess, the Hunts failed to adequately assess the risks associated with their plan to corner the silver market. Their confidence, primarily rooted in vast wealth, led them to believe they could withstand market volatility and any potential backlash from regulators. This lack of foresight was a critical miscalculation. The Hunts underestimated the power of market dynamics. Their aggressive acquisitions and escalated prices eventually drew a reaction from the financial establishment. By failing to anticipate the potential consequences of their actions, such as how quickly prices could drop in response to regulatory changes, the brothers set themselves up for catastrophic financial loss, particularly evident on Silver Thursday. The role of leverage. In this section, we examine how the Hunts utilized leverage to amplify their investments and the subsequent financial implications of their strategies. Leverage in trading. The Hunt brothers adeptly employed leverage as a key strategy in their quest to accumulate vast quantities of silver. By borrowing substantial funds, they significantly increased their buying power, allowing them to purchase silver at an unprecedented scale. This tactic amplified their potential gains, as rising silver prices meant that even small fluctuations could lead to significant profits. However, this practice also raised the stakes considerably. The brothers' aggressive borrowing meant they were exposed to heightened financial risks, as a decline in silver prices could have devastating effects on their investments. Their ability to control the silver market was further fueled by this leverage, enabling them to manipulate prices at least temporarily. The Hunts believed that owning physical silver would hedge against inflation and protect their wealth, but their reliance on borrowed funds created a precarious situation that would soon become evident. Risk of high leverage. The Hunts' strategy of utilizing high leverage ultimately exposed them to significant risk. While the initial rise in silver prices provided a sense of security, the volatility of the market spiraled beyond their control. As silver reached historic prices, any downturn could trigger a cascade of financial losses that the brothers were ill-prepared to handle. The risk became apparent on Silver Thursday when new trading regulations were imposed, forcing the prices into a free-fall. With their heavy reliance on borrowed money, the Hunts faced not only the loss of their investments, but also the threat of margin calls and the demand for immediate repayment. This situation illuminated the vulnerability associated with high leverage, transforming what was once a promising strategy into a catastrophic misstep. Diminishing returns. As the Hunts continued to acquire silver, their appetite for leverage grew exponentially. Initially, the rising prices provided a steroid-like boost to their investments, however. This unyielding pursuit quickly turned into a double-edged sword. The more silver they acquired, the more dependent they became on inflated prices to sustain their financial activities. By the time they peaked, their position in the silver market was not just monumental, it was also unsustainable. Each additional investment in silver came with diminishing returns, meaning that the incremental profit margins were declining while their risk exposure was simultaneously growing. The inability to realize continued gains led the brothers into a precarious balance, where their extravagant ambitions became increasingly out of touch with market realities. Lessons on risk. The dramatic rise and fall of the Hunt brothers serve as a powerful lesson about the dangers of high leverage in financial markets. Their experience highlights how leverage can distort perception, leading investors to believe that risks are outweighed by the potential for outsized profits. In reality, this often leads to catastrophic consequences during market volatility. Entrepreneurs should take heed of the Hunt brothers' tale as a cautionary reminder that in finance, unchecked ambition can result in ruin. Understanding the balance between risk and reward is crucial, as is the importance of maintaining sustainable financial practices. Their downfall underscores the necessity of sound risk management principles in trading and investment strategies. Market dynamics and public perception. This section discusses how the Hunts' massive buying habits influence public perception and market dynamics, altering the landscape of commodity trading. Media attention. The Hunts attracted significant media coverage during their ambitious pursuit of silver, turning them into household names. This media exposure played a crucial role in amplifying public interest in silver as an investment vehicle. News outlets raced to cover the brothers' massive buying spree, portraying it as a revolutionary move against economic instability. Headlines emphasized their ability to man the silver market, which ignited speculation among both seasoned investors and the general public. As stories about Bunker and Herbert Hunt flooded the news, the narrative surrounding silver shifted dramatically. The combination of their wealth and the media's focus created a perception that investing in silver was not only prudent, but also a gateway to potentially immense profits. This led to increased participation in the silver market, further bolstering the Hunt strategy. Influence on market behavior. The Hunts' aggressive accumulation of silver fundamentally altered market behavior and dynamics in the late 1970s. Their strategy created a compelling narrative that silver was a guaranteed investment, prompting other investors to jump on the bandwagon. This influx of new investors into the silver market intensified demand and drove prices higher, creating a self-fulfilling prophecy. As more participants entered the fray, the Hunts appeared to have validated their belief that silver would be a safe haven against inflation. Consequently, the market dynamic shifted from one of cautious speculation to frenzied optimism. This behavior underscored the psychological factors at play in commodity trading, demonstrating that perception could heavily influence investment decisions and market outcomes. Public skepticism. Despite the initial excitement about rising silver prices, skepticism began to permeate discussions around the Hunt brothers' approach. As prices soared past $50 an ounce, many questioned the sustainability of such an unprecedented surge. Critics emerged, arguing that the Hunts' actions constituted market manipulation, raising concerns about the ethical implications of attempting to corner a commodity market. This skepticism prompted public debates among economists, investors, and financial analysts regarding the balance between investment strategy and market ethics. This growing doubt also reflected a broader reluctance to place unreserved faith in the Hunts' investments, leading to increased volatility as some investors opted to sell their holdings amidst fears of an impending crash. The combination of rising scrutiny and criticism foreshadowed the tumultuous events that would later unfold. Long-term impact. The audacious strategy employed by the Hunt brothers has had lasting effects on the perception of commodities in the financial world. Their near cornering of the silver market not only demonstrated the volatile nature of trading, but also highlighted the risks associated with large-scale speculative practices. In the aftermath of the Hunt's collapse and the subsequent Silver Thursday, discussions surrounding market regulation and manipulative practices became more prominent. Investors became more cautious and aware of the potential ramifications of speculative behavior. The events also influenced how future commodities were treated, leading to more stringent regulations and a more skeptical view of similarly aggressive trading tactics. Ultimately, the Hunt's journey serves as a cautionary tale for entrepreneurs, emphasizing the importance of due diligence and the potential consequences of unchecked greed in the financial landscape. Chapter 4, Accumulation Strategies. In this chapter, we look at the methods used by the Hunt brothers to acquire silver. From off-market purchases to forming strategic partnerships, discover the logistics and strategies behind their aggressive accumulation approach, understanding the silver market. To effectively accumulate silver, the Hunt brothers first needed a deep understanding of the silver market dynamics. This involved analyzing supply and demand, pricing trends, and market sentiment toward precious metals. Their strategy hinged on grasping the nuances that would allow them to make informed purchasing decisions. Market analysis. The Hunts recognized that a thorough market analysis was essential for their accumulation strategy. They diligently studied historical price fluctuations of silver, looking for patterns that signaled future market shifts. Their research involved examining macroeconomic indicators such as inflation rates, currency fluctuations, and geopolitical events that historically influenced silver prices. By identifying trends, the brothers could predict when the market was likely to rise or fall, enabling them to time their purchases strategically. For instance, they noted how periods of economic uncertainty often led to surges in precious metal prices. Understanding these cycles allowed them to develop a comprehensive approach to buying silver, maximizing their profit potential while minimizing exposure to risk. Supply and demand. Another crucial pillar of the Hunts and APOS strategy was their keen focus on supply and demand dynamics. They actively monitored global silver production and mining output, correlating this data with their purchasing decisions to predict availability. By analyzing international mining reports and production forecasts, the Hunts aimed to ascertain when silver would become scarce. This knowledge enabled them to anticipate price increases, driving them to acquire silver reserves before prospective shortages would lead to inflated prices. Their proactive approach to understanding the silver supply chain proved instrumental in their ability to build a significant inventory of this precious metal. Investor behavior. The Hunts also delved into the psychology of investors, recognizing that understanding other market participants' sandapos reactions could provide substantial advantages. By studying market sentiment and behavior, they could foresee how shifts in news and economic indicators would likely influence investor decisions. This insight allowed the brothers to predict significant market movements, positioning themselves to either capitalize on a surge or mitigate losses during downturns. By gauging the emotions and strategies of individual investors and institutions, they crafted approaches to camouflage their buying activities. This understanding of investor psychology was crucial in their attempt to corner the silver market effectively. Technical indicators. The Hunts employed a variety of technical indicators to refine their purchasing decisions. Utilizing charts and sophisticated analysis tools helped them interpret complex market data visually. They focused on key indicators such as moving averages, volume trends, and relative strength indexes to identify optimal buying opportunities. By systematically applying these tools, the brothers were able to assess market momentum and price behavior efficiently. This empirical approach allowed them to time their entries and exits with precision. Ultimately, their blend of technical analysis with a broader understanding of economic principles and market psychology formed the foundation of their audacious trading strategy in the silver market. Off-market purchases. The Hunt brothers employed off-market strategies to acquire silver without driving up the price publicly. These discrete purchases allowed them to amass large quantities without attracting the attention of other investors or the government. Direct negotiations. The Hunt brothers employed direct negotiations with silver dealers and mining companies to secure bulk purchases of silver. This approach allowed them to bypass public trading platforms where their intentions could be easily perceived. By directly contacting producers and dealers, they engaged in one-on-one discussions that facilitated better pricing and terms. This tactic not only helped them avoid the attention of other investors, but also enabled them to create tailored deals that met their unique needs. Through these negotiations, the Hunts were able to establish long-term relationships with key suppliers, ensuring a steady and reliable flow of silver. Their willingness to negotiate directly also afforded them an edge in acquiring large quantities without driving prices up due to heightened demand or competition. This strategic method was a cornerstone of their accumulation strategy, showcasing their ability to operate stealthily in a volatile market. Confidential bids. To further conceal their market activities, the Hunts utilized confidentiality contracts during their procurement process. By entering into agreements that shielded their purchasing intentions from public scrutiny, they were able to operate without alerting other market participants or regulators. This strategic choice prevented the typical market reactions that would follow a significant buy order, which could lead to inflation in silver prices. These confidential bids allowed the brothers to collect substantial amounts of silver while keeping their strategies and quantities undisclosed. This approach minimized the risks associated with market manipulation accusations and enabled them to maintain an element of surprise, an essential factor in their accumulation strategy. Overall, confidentiality became integral to their campaign, ensuring their moves remained largely hidden from their competitors. Networking with industry contacts. The Hunt brothers capitalized on their extensive networks within both the oil and mining industries, leveraging personal relationships to identify lucrative silver opportunities. Their status as wealthy oil tycoons granted them access to influential contacts, allowing them to negotiate deals that were often unavailable to the average investor. By tapping into these connections, the brothers could gain valuable insights into market conditions and opportunities. Networking not only facilitated direct access to silver supplies, but also provided the Hunts with intelligence regarding other players' movements in the market. This advantage helped them formulate strategies that could successfully counteract competitive pressures. Their ability to work within established networks exemplified their resourcefulness and strategic foresight in a crowded marketplace, ensuring they were always one step ahead. Market timing. Strategic market timing played a crucial role in the Hunt brothers' off-market purchase strategy. By initiating their silver acquisitions during periods of market lulls, they avoided inflating the price through large order. Placements. This meticulous attention to timing allowed them to capitalize on lower prices, maximizing their purchasing power while minimizing attention. Understanding market cycles was key to their success, as entering the market at the right moment made a significant difference in their overall cost structure. The Hunts employed a disciplined approach, analyzing market trends and sentiment to identify optimal buying windows. This practice not only showcased their proficiency in commodity trading, but also reflected their strategic acumen, ensuring they amassed silver effectively without triggering adverse market reactions. Strategic partnerships. The Hunts understood the value of collaboration in commodity trading. By forming alliances with key players, they fortified their position in the silver market and expanded their acquisition capabilities. Joint ventures with miners. The Hunt brothers recognized that collaborating directly with silver miners could be highly advantageous. By forming joint ventures, they were able to negotiate favorable terms for purchasing silver. This approach ensured they had a secure supply and control over a substantial portion of the production process. These partnerships often included long-term contracts that locked in prices, providing predictability in a volatile market. By investing capital into mining operations, the Hunts not only gained preferential access to silver but also involved themselves in the mining process, which further solidified their position in the market. Such strategies exemplified a proactive approach to commodity trading, emphasizing the significance of aligned interests and mutual benefits in fostering lucrative opportunities. Financial backers. To support their ambitious silver buying initiatives, the Hunts sought partnerships with other wealthy investors. By aligning with established financial backers, they significantly reduced their individual risk exposure. These alliances allowed the brothers to amass large quantities of silver without relying solely on their personal fortunes. The financial backing facilitated a scaling of their operations, as it provided not just capital but also a buffer against market fluctuations. Networking with affluent investors and strategically pooling resources enabled the Hunts to engage in aggressive purchasing strategies, positioning themselves as dominant players in the silver market during the late 1970s. This underscores the importance of financial partnerships in high-stakes investment scenarios. Collaborative leverage. Collaboration among partners is crucial in commodity markets, and the Hunts effectively harnessed this principle. By combining the buying power of several investors, they were able to create a formidable presence in the silver market. This collective strength had the potential to influence market prices and buyers' perception significantly. The united front enabled them to launch larger purchases, driving demand and consequently price increases. This strategy not only bolstered their purchasing capabilities but also deterred competitors. The collaborative leverage established by the Hunts and their partners illustrated how unified efforts can lead to significant market impacts, demonstrating that strength often lies in numbers. Sharing information. In the fast-paced commodity trading environment, timely and accurate information is vital. The Hunts understood that collaboration allowed them to share critical market insights with their partners. This transparency created a network where intelligence regarding market conditions and emerging trends could flow freely, aiding in strategic decision-making. By exchanging insights on supply forecast, geopolitical factors, and market sentiment, the Hunts were able to navigate the complexities of the silver market with greater confidence. This collaborative approach also fostered trust among partners, enhancing the overall effectiveness of their trading strategies. The experience demonstrated how a well-informed network can contribute to informed trading decisions and improved market positioning. Legal and regulatory navigation. As they intensified their accumulation efforts, the Hunts had to navigate the complex legal and regulatory landscape governing commodity trading. Understanding these regulations was key to avoiding pitfalls while continuing their aggressive strategies. Compliance with SEC regulations, maintaining compliance with the Securities and Exchange Commission regulations was crucial for the Hunt brothers as they embarked on their ambitious silver accumulation strategy. The SEC oversees securities markets and ensures fair practices, which includes the trading of commodities like silver. By adhering to these guidelines, the Hunts could avoid legal challenges that might impede their operations or result in costly penalties. The brothers recognized that large-scale investments, especially in a volatile market, could attract scrutiny from regulators. Therefore, they strategically structured their purchases to remain within legal frameworks. This involved careful planning and monitoring of public filings, ensuring that their trades did not violate disclosure requirements. Such diligence enabled them to sustain their significant holdings without drawing unwanted attention, allowing their operations to proceed relatively unhindered. Understanding market manipulation laws. The Hunt brothers were acutely aware of the anti-manipulation laws governing commodity trading. These laws were designed to prevent market distortions that could arise from large purchases or strategic trading behaviors that could artificially inflate prices. As they pursued their goal of cornering the silver market, the Hunts had to navigate these legal intricacies with caution. Any signs of market manipulation could have severe repercussions, including investigations and sanctions from regulatory bodies. Hence, the brothers carefully analyzed the implications of their acquisition strategies, ensuring that their buying tactics did not inadvertently signal malfeasance. The success of their operation hinged on their ability to make significant purchases while avoiding legal repercussions, a balance that required continuous assessment of their trading activities and market conditions. Monitoring government policies. The Hunt brothers realized that to successfully execute their silver accumulation strategy, they needed to keep a close watch on the evolving landscape of government policies affecting commodity trading. Changes in regulations, particularly those linked to commodities, could directly impact their acquisition efforts and overall market dynamics. Their ability to anticipate such changes was vital for strategic planning. By actively monitoring political and economic developments, the Hunts could adapt their strategies in anticipation of potential regulatory shifts. For instance, they paid special attention to any discussions within Congress regarding commodity speculation and trade practices. This proactive approach allowed them to adjust their tactics accordingly, ensuring that they remained adaptable in a rapidly changing environment that could threaten their extensive silver holdings. Impact of legislation on trading. The potential impact of new legislation on silver trading was a significant consideration for Bunker and Herbert Hunt. They understood that regulatory changes could alter the trading landscape, affecting everything from buying limits to market access and potentially jeopardizing their extensive silver positions. Thus, assessing the likelihood and ramifications of proposed laws became a core component of their strategizing process. The brothers were keen analysts of any legislative initiatives that might influence silver prices or trading practices. By staying informed of upcoming bills and policy discussions, they were able to anticipate market reactions and adjust their acquisition timeline effectively. This foresight was critical in ensuring that their ambitious plans remained intact in the face of legislative developments that could influence the silver market and the broader commodity trading environment. Chapter 5, The Silver Surge. This chapter details how the Hunts' purchasing activities influenced silver prices, sending them sky high from $6 to $50 an ounce. We will examine the psychological impact on investors and how market sentiment played a crucial role during this time. The Hunt brothers' strategy. The Hunt brothers developed a strategy to accumulate large quantities of silver, in order to create a scarcity that would drive prices higher. Their plan was simple yet ambitious: buying physical silver to influence the market. Intent behind buying silver. The Hunt brothers viewed silver primarily as a hedge against inflation and a safeguard during a period of economic uncertainty. In the late 1970s, rampant inflation and concerns over the stability of the U.S. dollar led them to believe that traditional investments were at risk. They perceived silver not just as a commodity, but as a long-term store of value. This perspective was driven by historical precedents, where precious metals retained their value in times of currency devaluation. The brothers aimed to capitalize on external economic fears and instill confidence in their investment strategy. By accumulating vast amounts of silver, they hoped not only to shield their wealth but also to influence market dynamics to their advantage. Their strategy relied heavily on the belief that their actions would create a perceived scarcity, amplifying the metal's value in the public eye. This ideal propelled their aggressive, somewhat speculative approach to commodity trading. Massive purchases. The Hunt brothers embarked on a bold strategy of purchasing silver contracts in the futures market, which allowed them to control significant quantities of silver with a relatively small upfront investment. This approach was both innovative and risky, as it leveraged financial instruments to layer their holdings without the immediate need to exchange large sums of cash. By purchasing futures contracts, they could exert influence over silver prices without physically holding all the silver immediately. Their strategy allowed them to enter into agreements for future delivery of silver at set prices, which they believed would appreciate considerably. This mechanism also provided a means to manipulate market perception. If enough investors believed that the Hunts were cornering the silver market, additional speculative buying would inevitably follow, further driving up prices. Physical silver accumulation. In conjunction with their futures contracts, the Hunt brothers aggressively stockpiled physical silver. They acquired it from mints and dealers worldwide, with the audacious goal of controlling an astonishing 1/3 of the world's privately held silver. Their strategy aimed not only at creating markets around their holdings, but also at ensuring that they possessed tangible assets amidst market volatility. This accumulation wasn't just a financial strategy, it was also symbolic, showcasing their ability to physically dominate a vital commodity market. The Hunts believed that by owning such large quantities of physical silver, they could manipulate supply dynamics and consequently influence prices more directly than if they solely relied on futures markets. This bold accumulation came to define their profile in the financial world and set the stage for both remarkable success and catastrophic failure. Impact on market perception. The Hunts' aggressive buying strategy significantly affected market perception, creating a dramatic ripple effect that captured the attention of investors both large and small. As the brothers' actions became widely known, expectations soared and many investors began to speculate on silver, believing it to be undervalued and witnessing a transformative moment for this precious metal. This heightened interest led to an influx of new investors jumping on the silver bandwagon, inadvertently contributing to the price inflation that the Hunts had initially sought. This burgeoning market enthusiasm, driven by a combination of fear and hope, further accelerated the rise in silver prices to unprecedented levels. Consequently, the Hunts not only shifted the market dynamics, but also manipulated the psychological landscape of investors, ultimately transforming silver into a hot commodity at that time. However, the very nature of market sentiment is often volatile, as seen during the heights of their investment strategy, leading to unforeseen consequences in the volatile trading environment of the early 1980s. Price surge and speculation. The months leading up to the peak silver price saw a frenzy of speculation. Prices surged as more traders entered the market, anticipating profits similar to those the Hunts were enjoying. Rapid price escalation. Between 1979 and early 1980, the price of silver experienced a dramatic escalation, soaring from approximately $6 to nearly $50 an ounce. This meteoric rise was largely fueled by the aggressive buying strategies of the Hunt brothers, who sought to corner the silver market amidst rising inflation fears. Their tactics included accumulating vast quantities of physical silver, which significantly reduced the available supply for other traders. The Hunts' purchasing spree not only influenced prices directly, but also set off a wave of speculative trading. As news spread of their efforts, more investors started buying silver with the hope of mirroring the Hunts' profitability. This influx of new capital created a feedback loop, where rising prices attracted even more buyers, further propelling the market upward. The surge in silver prices became a historic lesson in market manipulation and speculation, illustrating how one entity's actions can dramatically affect global commodity prices. The enthusiasm surrounding silver trading undeniably reflected the rampant speculation characteristic of financial bubbles. Psychological impact on investors. The surge in silver prices during this period led to a potent psychological effect among investors, particularly the fear of missing out. As silver prices climbed higher, many individual investors became increasingly anxious about missing profit opportunities. This drove many to enter the market, believing they could also capitalize on the considerable gains experienced by the Hunt brothers. This FOMO phenomenon created an atmosphere of urgency that was palpable in the market, with investors rushing to buy silver before prices rose even further. This psychological push contributed significantly to heightened trading volumes, drawing both seasoned traders and novices who hoped to strike it rich. Furthermore, the conditions were ripe for emotional decision-making rather than strategic investing. Many rushed into the market without fully understanding the underlying fundamentals, willing to ignore potential risks as they focused on the seemingly limitless potential for profits. Community sentiment. As silver prices surged, investor communities, particularly among smaller traders, began to mirror the Hunt's bullish sentiment. Enthusiasm spread like wildfire throughout these circles, creating a silver rush atmosphere where speculation replaced careful analysis. Reports of the Hunt brothers becoming billionaires directly tied to their silver investments sparked dreams of wealth among everyday investors. The notion of collective action gained traction, with forums and trading groups buzzing with excitement about the silver market. These communities reinforced each other's optimism, encouraging participation from those who may have previously been hesitant. This herding behavior amidst retail investors significantly amplified the market's volatility. This communal sentiment not only fueled further speculative buying, but also turned silver into a popular topic in financial discussions, adding to the frenzy. In this climate, many traders felt emboldened by the perceived momentum and the idea that they were part of a revolutionary financial movement driven by the Hunt brothers' activities. Media coverage. The media played a critical role in amplifying the buying pressure during the silver surge. Headlines highlighting the Hunt brothers' aggressive strategies and skyrocketing wealth captured the public's attention, enticing more speculators to invest in silver. With coverage frequently celebrating the whirlwind success of the Hunts, the narrative of silver becoming the new gold emerged strongly in public consciousness. However, this attention brought risks as well. Increased media scrutiny led to heightened volatility and erratic price movements. In an environment where sentiment was so heavily influenced by headlines, the potential for rapid shifts in investor behavior became dangerously pronounced, highlighting the fragility of fleeting market euphoria driven by external narratives. Influence of leverage. Leverage played a crucial role in the Hunt brothers' strategy. It's essential to understand how using borrowed funds magnified both their gains and losses during this volatile period. Understanding leverage. Leverage is a financial strategy that involves using borrowed funds to increase the potential return on investment. For the Hunt brothers, it was a tool that enabled them to acquire a significantly larger position in silver than their available cash reserves would allow. By borrowing money to finance their silver purchases, they effectively amplified their buying power. This strategy not only escalated their market presence, but also allowed them to manipulate prices more effectively. As they accumulated vast quantities of silver, the Hunts were able to exert considerable influence on the market, driving prices from a modest $6 per ounce to an astonishing $50. However, while leverage provided them with substantial gains, it also posed significant risks, particularly when market dynamics began to shift. Risks associated with leverage. Though leveraging can enhance potential profits, it also introduces a heightened risk of substantial losses. The Hunt brothers' reliance on borrowed funds meant that any downturn in silver prices would disproportionately affect their financial position. For every dollar increase in silver's value, their profits increased exponentially. Conversely, any decline in prices would equally magnify their losses. The precarious nature of using leverage became evident as volatility rocked the silver market. The Hunts were caught in a dangerous game of speculation where, despite their expertise in financial prowess, the limitations of leveraged trading quickly became apparent. Their experience serves as a stark reminder to entrepreneurs of the fine line between daring investment strategies and reckless financial risk. Margin calls. Margin calls are events triggered when the equity in a leveraged account falls below a certain level, usually due to a decline in the asset value. As the price of silver began to fluctuate during 1980, the Hunts faced significant margin calls, forcing them to provide additional collateral to maintain their positions. This scenario was particularly stressful as it not only drained their cash reserves, but also escalated their overall financial exposure. Each time the price of silver dipped, the requirement to come up with more capital put immense strain on their resources. This scenario not only reflected the volatility and unpredictability of the market, but also illustrated the perilous nature of high leverage strategies, highlighting the potential for rapid financial decline in the face of adverse market conditions. Consequence of over-leveraging. The culmination of the Hunt brothers' aggressive leverage strategy ultimately led to a catastrophic financial fallout. By over-leveraging their investments in silver, they positioned themselves precariously vulnerable to any rapid market changes. When the U.S. government intervened on Silver Thursday, altering trading rules and bringing prices crashing down, the Hunts found themselves unprepared for the magnitude of loss they would incur. The high level of leverage not only magnified their initial positions, but also exacerbated their losses, leading to a staggering financial collapse. This episode serves as a cautionary tale for entrepreneurs regarding the dangers of excessive leverage and the importance of risk management in financial trading. Understanding the impact of leverage on both gains and losses is essential for maintaining financial stability in volatile markets, market reactions, and government intervention. The unprecedented price rise of silver did not go unnoticed by the government and regulatory bodies, leading to intervention that would drastically alter market dynamics. Regulatory response. As the price of silver soared to unprecedented heights, government officials raised serious concerns regarding potential market manipulation. The Hunts' aggressive accumulation strategy sparked scrutiny, echoing fears reminiscent of previous market abuses. Regulatory bodies, witnessing the unusual trading patterns, began questioning the legitimacy of the Hunts' practices. U.S. legislators and financial regulators were alarmed by the rapid surge, prompting meetings to discuss the implications of such concentrated ownership in a key commodity. This heightened scrutiny represented a shift from a liberally structured market to one perceived as vulnerable to exploitation. Critics argued that the Hunts' actions deviated from ethical market conduct, suggesting a risk not only to the integrity of silver trading, but to broader economic stability. Changes in trading rules. In direct response to the rising silver prices and concerns over market manipulation, regulatory authorities made significant changes to futures trading rules. These adjustments aimed to curb the Hunts' ability to leverage their extensive silver holdings and alter market dynamics dramatically. The new rules included increased margin requirements that effectively limited the number of contracts traders could hold. This intervention was a pivotal moment, restricting the Hunts' operational capacity in the silver market. The changes impacted not only their strategies, but also the expectations of other market participants. Investors quickly realized that the regulatory landscape had shifted, injecting new fears about the sustainability of the price rally and the long-term health of silver investments. Market corrections. The regulatory changes swiftly triggered a correction in silver prices, which had been buoyed by the Hunts' manipulation efforts. As rules tightened, the market began to reject the inflated valuations that had characterized the silver boom. Prices, which had surged to $50 an ounce, started to plummet as the reality of the Hunts' constrained trading set in. This sudden correction highlighted how government intervention can swiftly alter the balance of power within financial markets. The Hunts, unable to maintain their grip due to newfound rules, saw their silver holdings lose value rapidly. Consequently, the market's exuberance faded, emphasizing the inherent risks associated with attempting to corner a commodity market. Investor panic. As news of government intervention spread, panic swept through the investment community. Many investors, initially drawn to the silver market by the impressive price increases, now feared a collapse. The erosion of confidence sparked widespread sell-offs, further exacerbating the downward pressure on silver prices. This sell-off was fueled by the growing perception that the market was unsteady and manipulated. As silver values began to tumble, investors rushed to liquidate their holdings, fearing substantial losses. The psychological impact of regulatory changes, combined with uncertainty about future price stability, led to a chaotic market response that ultimately contributed to the Hunts' financial downfall. The aftermath of Silver Thursday. Silver Thursday, March 27, 1980, marked a dramatic turn of events for the Hunt brothers as their ambitions unraveled in a single day, leading to significant financial and reputational consequences. Sudden price collapse. The chaotic events of Silver Thursday caused a dramatic collapse in silver prices, plummeting from nearly $50 an ounce to around $11, within a shocking span of just a few days. This unprecedented downturn was not only rapid but also catastrophic, particularly for the Hunt brothers, who had amassed vast quantities of silver in their bid to dominate the market. Their aggressive purchasing strategy, which once seemed poised to secure their financial legacy, instead transformed into a staggering loss. This sudden price drop amplified the vulnerability inherent in commodity markets. The Hunts' dream of controlling the silver market unraveled as selling pressure intensified, leading to a liquidity crisis that left them. learning reading speed 38%, unable to adjust their positions in time. The ripple effects of this collapse reverberated throughout the financial community, serving as a stark reminder of how swiftly market dynamics can shift. Impact on the Hunt's wealth. On that fateful day, the Hunt brothers lost over $1 billion, a staggering sum that epitomized the high-stakes world of commodity trading. The vast wealth they had accumulated through their oil ventures suddenly felt paper-thin as the value of their silver holdings dwindled overnight. This financial debacle not only highlighted the immense risks associated with such speculative trades, but also underscored the volatility inherent in the commodity market. The scale of the loss prompted a reassessment of the brothers' financial strategies and their leveraging tactics. In utilizing borrowed funds to acquire silver, they had stretched their exposure to an unsustainable level, illustrating how extreme confidence in a particular asset can lead to disastrous consequences when market conditions shift unpredictably. Shifts in investor confidence. The fallout from Silver Thursday significantly eroded investor confidence in silver as a reliable hedge against inflation. Prior to this crash, silver was seen as a safe asset, but the abrupt plunge in price compelled many investors to reconsider their positions. Fear and uncertainty took the place of optimism, leading to a sell-off that impacted silver's perceived value for years to come. As news of the Hunt's troubles spread through market circles, potential investors became wary of entering the silver market. The psychological impact of the Hunt's failure served as a warning sign for future commodity traders, reminding them that even well-structured investment strategies could collapse under sudden market pressures. This shift in sentiment fundamentally altered future trading behaviors and strategies concerning precious metals. Legacy of caution. The dramatic rise and fall of the Hunt brothers in the silver market have left a lasting legacy, serving as a cautionary tale for investors and traders alike. Their story emphasizes the dangers of unchecked ambition and the pitfalls of greed in volatile markets. Many who study their downfall now recognize the importance of diversification and prudent risk management in trading practices. This legacy extends beyond just commodities. It is a reminder that market manipulation, while potentially lucrative, can have devastating consequences. The Hunt's failure highlighted the necessity for regulatory oversight and underscored the value of maintaining a disciplined approach to investing that prioritizes risk assessment. Their experience serves as a vital lesson on the inherent unpredictability of financial markets and the importance of humility and caution in the face of opportunity. Chapter 6. Greed and Speculation. The theme of greed is prevalent in any financial market, but it was particularly pronounced during this period. This chapter scrutinizes how the Hunts fueled speculation and the evolving narrative around their wealth, leading to both admiration and skepticism. The roots of greed. Understanding the roots of greed provides insight into the mindset of the Hunt brothers. Greed can be a powerful motivator in the world of finance, often leading individuals to take risks that can result in incredible gains or catastrophic losses. Greed as a driving force. During the late 1970s, the United States faced economic turmoil marked by high inflation and a depreciating dollar. In such a climate, the Hunt brothers found themselves motivated by a profound sense of insecurity and opportunity. Greed as a driving force compelled them to amass an astronomical amount of wealth in the silver market. This was not merely about accumulating riches, it was about wielding influence and control in an unstable economic landscape. The Hunts recognized that becoming major players in the silver market could provide them not just financial security, but also power. As they surreptitiously bought vast quantities of silver, they were driven by an obsession to manipulate market dynamics. Their avarice, however, would not only reshape their fortunes, but also highlight the inherent risks tied to unchecked ambition. The fear of missing out on a seemingly lucrative investment compounded their desire, propelling them into the realm of speculative greed. Wealth perception. The Hunts were not just perceived as wealthy oil tycoons, they became emblematic figures within the broader discussion of wealth and power in commodity trading. Their ambitious attempts to corner the silver market earned them both admiration and criticism. On one side, they were seen as visionary pioneers who boldly challenged the financial orthodoxy. On the other, they were criticized for their ostentatious displays of wealth and ambition. This dual perception fueled a narrative that captivated both the public and financial institutions. While many respected their financial acumen and daring strategy, others questioned the ethics underlying such aggressive speculation. The Hunts became symbols of a larger discussion about the morality of wealth accumulation in an era driven largely by greed. This complex perception would shape the ongoing interactions between the brothers and the financial community as the stakes continued to rise. context of inflation. Amid rising inflation rates, the economic landscape of the late 1970s created fertile ground for speculative investments. For many wealthy individuals, the idea of investing in tangible assets like silver was particularly appealing as an inflation hedge. The Hunts exploited this collective anxiety, positioning themselves as saviors in a turbulent economy. Their aggressive accumulation of silver at a time when many sought refuge in physical assets underscored broader trends in commodity trading. This environment fostered a culture of speculation, encouraging investors to chase profits in a market ripe with volatility. The Hunt brothers capitalized on this zeitgeist by leveraging their oil wealth to fuel an unprecedented silver buying spree. Such speculative maneuvers, while offering high potential rewards, also carried the risk of catastrophic losses, exemplifying the dual nature of greed in a financial context. As the brothers pushed farther into the commodity world, the line between prudent investment and reckless speculation began to blur. Comparison to historical figures. The actions of the Hunt brothers echo those of other historical figures who were driven by greed in pursuit of power and influence. Figures like John D. Rockefeller and Andrew Carnegie also sought to dominate their industries, displaying an insatiable appetite for wealth that fundamentally altered economic landscapes. The Hunts' ambition to corner the silver market can be likened to these industrial magnates, whose legacies are marred by the consequences of their greed-driven pursuits. Such comparisons highlight the pervasive nature of greed throughout history and its capacity to motivate individuals toward monumental achievements or catastrophic failures. The Hunts' drive for control over silver mirrors the tactics of past tycoons who leveraged their fortunes to outmaneuver competitors. Ultimately, the Hunt brothers serve as a modern reminder of the lessons from history that unchecked greed often leads to dire repercussions both personally and economically, particularly in volatile markets. Speculation drives market behavior. Speculation creates volatility in financial markets, especially in commodities. The Hunts' approach to silver transformed them into catalysts for speculation on an unprecedented scale. Market speculation explained. Market speculation is the practice of buying assets with the intention of selling them at a higher price, rather than for their fundamental value. This approach was at the core of the Hunt strategy when acquiring silver in the late 1970s. They believed that rising inflation and global instability would drive up silver prices, making it a prime asset for speculation. By purchasing large quantities of physical silver, the Hunts aimed to create artificial scarcity, further inflating demand. The speculative fervor surrounding silver not only increased its price, but also attracted a plethora of new investors who were eager to partake in the perceived opportunity. As a result, speculation shifted from mere financial transactions to a frenzied activity characterized by fear and greed, ultimately reinforcing the volatile dynamics of the silver market. Impact of limited resources. The Hunts' endeavor to corner a substantial portion of the silver market had far-reaching implications. By controlling nearly one-third of the world's private silver supply, they effectively limited the available resources for other market participants. This monopolistic grip intensified speculative behavior as investors scrambled to secure their positions, fearing that the scarcity of silver would drive prices even higher. Such a limited resource scenario incentivized other traders to enter the market, often contributing to irrational price spikes. The Hunts' actions catalyzed a sense of urgency among investors, who became increasingly motivated by potential profits rather than the underlying fundamentals of the market. This whirlwind of speculation ultimately exacerbated the volatility of silver, morphing it into a hotbed of financial activity and uncertainty. Price manipulation concerns. As the Hunts' influence over the silver market grew, so did concerns about potential price manipulation. Many critics argued that their strategy could distort market prices, leading to an unstable economic environment. Regulatory bodies, alarmed by the implications of such concentration of power, began to scrutinize the Hunts' activities closely. These concerns culminated in a series of regulatory changes aimed at preventing undue manipulation in commodity markets. The perception of the Hunts as orchestrators of a financial corner became a significant narrative. In financial media, emphasizing the balance between speculative pursuits and ethical trading practices. This scrutiny illustrated the tension between aggressive market strategies and regulatory frameworks designed to maintain economic order. Sociocultural implications. The rampant speculation spurred by the Hunts' actions had profound sociocultural implications. As silver prices skyrocketed, it altered public perception of commodities. They became viewed as viable investment vehicles rather than mere assets for industrial use. This shift encouraged a wave of retail investors to enter the commodity markets, often lacking the sophisticated knowledge necessary for prudent investing. Moreover, the events of this period brought discussions about wealth, speculation, and risk to the forefront of American consciousness. Investors began to question traditional asset classes and look toward alternatives influenced by the dramatic price movements in the silver market. This cultural shift represented a paradigm change that resonated within investment communities, igniting a new era of hedge fund strategies and speculative trading practices that continue to influence the markets today. The chase for wealth and control. The pursuit of wealth by the Hunts was not merely financial, but also a quest for control over a commodity that was seen as a hedge against economic insecurity. The allure of silver. The Hunts perceived silver not merely as a commodity, but as a fundamental pillar of power in an uncertain economic landscape. At a time when inflation was rampant and the dollar's stability was questioned, silver offered a tangible asset that could secure their wealth and influence. This perspective elevated their desire to acquire more silver, transforming what began as an investment strategy into a fervent obsession. For the brothers, silver symbolized a refuge amid financial turmoil. Their vision of amassing vast quantities of silver was not solely about monetary gain. It was rooted in a deeper aspiration for autonomy against governmental and economic volatility. As they increasingly equated silver with security, their speculative ventures took on an almost ideological quality, as if they were crusading against the very forces they feared. Strategies for accumulation. The Hunts implemented a series of tactical strategies to accumulate silver, with leverage being a cornerstone of their approach. By borrowing heavily to finance their purchases, they were able to significantly amplify their holdings. This strategy enabled them to control a substantial portion of the global silver supply, enhancing their market influence dramatically. However, leveraging assets also intensified their exposure to financial risk. The very strategies that expanded their wealth could result in catastrophic losses. As silver prices soared, so too did their debt levels, creating a precarious balancing act between enormous potential gains and equally substantial threats to their financial stability. This high-stakes game of speculation ultimately culminated in the dramatic events of Silver Thursday. Psychological factors. The psychological dimensions of the Hunts' pursuit of wealth were profound. Their control over the silver market fostered a sense of empowerment that was deeply intoxicating. The brothers believed that their actions conferred not just financial success, but also a kind of moral superiority in an era of economic mistrust. This perception of control reinforced their determination to pursue their speculative objectives, often blinding them to the inherent risks involved. Their identity became intertwined with their market manipulation efforts, blurring the lines between rational investment strategy and reckless ambition. As their conviction grew, so did their vulnerability to the psychological pitfalls characteristic of high-stakes speculation. Market perception. The Hunts were not merely players in the silver market. They were influential figures whose actions shaped public perception significantly. Their ambitious attempts to corner the silver market generated a mix of admiration and skepticism among investors and the general public alike. For many, they embodied the quintessential risk-taking entrepreneur, yet for others, they were emblematic of reckless greed. Admiration versus skepticism. The contradictory responses to the Hunts, ranging from admiration to skepticism, illustrate the complexities of human attitudes towards wealth and risk. Celebrity status. The Hunts became both envied and scrutinized figures in the financial world. Many individuals viewed them as pioneers of a new investment strategy, believing they had the foresight to identify tangible assets as a hedge against economic turmoil. Their immense wealth and unabashed pursuit of silver garnered admiration from a segment of the public who romanticized the idea of the outlaw investor challenging established norms. However, this admiration was counterbalanced by skepticism. Critics labeled them as reckless gamblers, suggesting that their speculative actions were not grounded in rational investment strategy, but rather driven by greed. This perception illustrated a duality in human response to wealth, where fascination with success coexisted with concern over the ethical implications of such bold moves. Media portrayal. Media narratives heavily influence public sentiment, often amplifying both their triumphs and failures. This pendulum swing between elevation as market heroes and derision as foolhardy speculators contributed to the Hunt celebrity status, further complicating the public's understanding of their actions and motivations within the context of financial speculation. The duality of risk. Investors often regarded the Hunts as symbols of bold decision-making, exemplifying the risk-taking nature emblematic of entrepreneurial success. Their strategy drew interest from those captivated by the high-stakes realm of commodity trading, inspiring admiration for their willingness to challenge conventional investment wisdom. Yet this boldness was juxtaposed with skepticism about the long-term viability of their approach. Many questioned whether cornering a market was sustainable or merely a fleeting gamble. This tension between admiration for their audacity and wariness of their methods reflects a fundamental duality in investing, where high rewards often come with equally high risks, prompting ongoing discussions about the nature of speculation in financial markets. Lessons learned. The mixed reactions to the Hunts provide crucial insights for aspiring entrepreneurs and investors. Their story illustrates the delicate balance between risk and reputation in business. Engaging in bold market maneuvers can capture public attention and potentially yield significant returns, yet these same actions can lead to skepticism and reputational damage if the outcomes are unfavorable. Ultimately, the Hunts experience serves as a cautionary tale, underscoring the importance of assessing risks and aligning one's public persona with sound investment strategy. For those navigating the complexities of financial markets, the lessons derived from their journey into silver can illuminate the perilous yet exciting landscape of entrepreneurial endeavors. The consequences of greed. While greed can drive innovation and investment, it can also lead to poor decision-making, as seen in the downfall of the Hunt brothers and the events of Silver Thursday. Uncontrolled ambition. The Hunts' relentless pursuit of silver not only showcased their ambition, but also illuminated the perils of unchecked desire for wealth. In the late 1970s, the brothers believed they could manipulate the silver market by acquiring vast amounts of the commodity. Their strategy was predicated on the belief that inflation would erode the value of the dollar, making physical silver a coveted asset. As they pushed their holdings to over one-third of the world's private silver supply, their ambition turned into a gamble that overshadowed sound financial judgment. The exponential rise in silver prices from $6 to $50 an ounce seemed to validate their strategy temporarily. However, this unbridled ambition lacked consideration for sustainability and risk management, resulting in catastrophic consequences when the market shifted dramatically. Ultimately, the Hunt's tale serves as a stark reminder that ambition, when left unchecked, can lead to financial disaster and ruin, particularly in volatile markets like commodities. Regulatory responses. In the wake of the Hunt brothers' aggressive silver market strategies, significant changes emerged in regulatory measures aimed at preventing similar market manipulation. The unprecedented volatility triggered by their actions drew sharp criticism from regulators, who perceived a need to intervene to maintain market integrity. By the end of March 1980, the Commodity Futures Trading Commission implemented new regulations that altered trading rules for commodities, including silver. These included limits on the size of futures positions and increased scrutiny over market transactions, aiming to mitigate the potential for another market cornering. The Hunt's maneuvers served as a catalyst for a broader discussion on market regulation, highlighting vulnerabilities in the commodity trading system. This marked a watershed moment, prompting regulators to reevaluate existing frameworks and implement measures to protect investors and stabilize markets in the future. Reputational damage. The Hunt brothers' reputation took a significant hit following their dramatic loss on Silver Thursday. Once celebrated for their wealth and influence in the oil industry, the brothers became synonymous with greed and hubris in the financial world. As the silver prices collapsed overnight, their image shifted from powerful tycoons to cautionary figures in market manipulation. This transformation underscores how quickly fortunes can turn in the world of finance. The Hunt strategies, seen as clever by some, were ultimately labeled reckless and self-serving. The fallout from their failure not only tarnished their personal brand, but also cast a long shadow over future market participants who sought to emulate their tactics. The reputational damage endured by the Hunts serves as a crucial learning point for entrepreneurs and investors, illustrating the importance of ethical decision-making and the potential consequences of overly ambitious pursuits. Reflection on the market. The aftermath of the Hunts' ventures into silver trading laid bare the intricate relationship between greed, speculation, and market regulation. As the silver market experienced unprecedented fluctuations, it became evident that unregulated ambition could destabilize not just individual fortunes, but the broader financial ecosystem. The events surrounding Silver Thursday acted as a microcosm of the larger risks associated with speculative behavior in any market. It sparked debates on the moral implications of greed in finance and whether ambition should be tempered with responsibility and foresight. Furthermore, the regulatory responses that ensued highlighted the necessity for a balanced approach to market controls. These developments called for a reassessment of what drives market behaviors and the essential role that regulations play in protecting both investors and the integrity of financial markets. Chapter 7, The Role of Leverage. Leverage is a double-edged sword in finance. This chapter explains how the Hunt brothers use leverage in their silver investments and the risks that come with such a strategy. It sets the stage for understanding the consequential fallout that would soon follow. Understanding leverage. Leverage allows investors to amplify their potential returns, but it also increases the risk of significant losses. This section explores the concept of leverage, particularly in the context of commodity trading and how it was employed by the Hunt brothers. Definition of leverage. Leverage is a financial strategy that involves using borrowed capital to amplify potential returns on investment. In essence, it allows investors to control larger positions than they could with their own funds alone. While leverage can significantly enhance profits, it equally magnifies losses, making it a double-edged sword. For instance, if an investor uses leverage to buy silver and the price rises, their gains can be substantial. However, if the market moves against them, they may face catastrophic losses, sometimes exceeding their initial investment. This inherent risk associated with leverage requires careful consideration and management, particularly in volatile markets such as commodities. Understanding both the potential rewards and risks of leverage is crucial for investors looking to make informed decisions in financial trading. Types of leverage. In financial markets, leverage can be achieved through various means, including loans, margin accounts, and derivatives. For instance, margin trading allows investors to borrow money from a brokerage to purchase more assets than they could independently afford. This was the predominant strategy employed by the Hunts in their silver investments. By using margin accounts, they could buy vast quantities of silver, significantly increasing their market exposure. Additionally, derivatives such as options and futures can provide leverage, enabling traders to gain large positions with a relatively small capital outlay. While these tools can create opportunities for amplified gains, they intensify the need for effective risk management due to the potential for significant financial loss. Leverage in commodity trading. Commodity markets are uniquely structured to enable traders to utilize leverage, allowing them to control larger positions than their capital would typically permit. This phenomenon is especially pronounced in metals like silver, where price fluctuations can be both rapid and extreme. By employing leverage, traders can capture substantial profits if the market moves favorably. However, this strategy also comes with the risk of devastating financial consequences if the market turns against them. The Hunt brothers' foray into silver illustrates this dynamic perfectly. Their control over the silver market was bolstered by significant leverage. Consequently, while this approach initially provided immense profit potential, it also left them vulnerable to catastrophic losses when the market environment shifted. The Hunt brothers' strategy. The Hunt brothers strategically utilized leverage to amass large quantities of silver, driven by the belief that rising inflation would bolster demand and prices for the metal. Their ambitious approach hinged on optimistic economic projections, which painted a picture of an imminent financial crisis that would lead to a spike in silver prices. By borrowing against their resources to finance these purchases, the Hunts were able to corner a substantial share of the silver market. This aggressive leveraging, however, came with inherent risks. As their positions grew larger, so did their potential for loss. When the market dynamics changed suddenly, the true peril of their strategy was laid bare, illustrating how heavy reliance on leverage can lead to dramatic financial misfortunes in commodity trading. The strain of debt. Using leverage means incurring debt, and this section discusses the financial strains that come with borrowing, especially in a volatile market. The Hunt brothers faced increasing pressures from their leveraged positions. Debt accumulation. The Hunt brothers' ambitious silver buying spree led to significant debt accumulation, primarily through the use of margin accounts. These accounts allowed them to borrow money to purchase large quantities of silver, effectively leveraging their initial capital investment. As the price of silver rose, this strategy initially seemed successful, fueling their extravagant purchases. However, margin accounts come with stringent requirements that necessitate maintaining a minimum account balance. If the value of their silver holdings dipped below this threshold, the Hunts risked facing margin calls. This precarious balance made their financial position increasingly vulnerable as they were compelled to monitor their investments closely, with each decline in silver prices translating directly to potential losses. The lesson here emphasizes how rapidly accumulating debt can spiral out of control, especially in speculative markets. Margin calls explained. A margin call is a critical threshold in leveraged trading, triggering when an asset's value declines. For the Hunt brothers, the stakes were exceptionally high. If the value of their silver holdings fell below a certain percentage of their initial margin, lenders could demand additional collateral or early repayment of their loans. This scenario creates substantial stress on any investor, but it was particularly acute for the Hunts due to the sheer volume of their silver purchases. Continuous increases in leverage meant that margin calls were always looming, exerting constant pressure on their liquidity. The psychological toll of facing potential liquidation of assets added an additional layer of complexity to their financial strategy, highlighting the inherent risks of such aggressive investment tactics. Impact of falling prices. As the price of silver began to fluctuate in early 1980, the Hunt brothers found themselves in an increasingly precarious situation. What had once seemed like an astute investment turned into a dire financial crisis. As silver's value fell dramatically, the pressure to meet margin requirements intensified, forcing the brothers to offload vast amounts of their silver holdings to avoid devastating losses. This reality showcased the risks associated with trading in volatile commodities. The Hunts' inability to stabilize their financial obligations in conjunction with declining silver prices illustrated how external market forces could swiftly shift the balance of control out of their hands. Ultimately, this supply-demand imbalance left them vulnerable to rapid financial decline, revealing the failings of relying heavily on leverage. Illusion of control. The Hunt brothers fostered a belief that they could indefinitely control silver prices through their massive acquisitions. This illusion was grounded in their initial success, but was dangerously misguided. Leverage can create a false sense of security, making investors feel invulnerable to market fluctuations. However, the volatility of commodity markets proved that no amount of capital could fully guarantee stability. When unexpected shifts occurred, the Hunts' financial framework crumbled. Their inability to fathom the true extent of exposure highlighted a crucial lesson: overconfidence in market. Manipulation can lead to severe repercussions. Their experience underscores the dangers of over-reliance on leverage without recognizing the inherent risks within market dynamics. Market manipulation and consequences. Leverage can lead to market manipulation if investors try to control prices through their significant holdings. This section discusses how the Hunt's strategic maneuvers influenced the silver market and the eventual backlash they faced. Attempt to corner the market. The Hunts embarked on an ambitious venture to corner the silver market by acquiring massive quantities of physical silver. Their strategy was built on the belief that a constrained supply would lead to soaring prices, aligning with their fears of rising inflation and a diminishing dollar value. By acquiring approximately one-third of the world's privately held silver, their influence transcended mere investment. It signaled a potential shift in market dynamics. However, this aggressive accumulation raised eyebrows within the financial community. Market players and analysts began to speculate on the sustainability of such a move. As the Hunts continued to amass silver, their actions not only increased prices rapidly from $6 to a staggering $50 per ounce, but also sparked concerns about ethical investment practices. This environment of suspicion prompted other market participants to consider defensive strategies, leading to a more cautious trading atmosphere. Regulatory scrutiny. As the Hunt brothers' silver holdings ballooned, regulatory authorities began to take a closer look at their activities. The dramatic price increases, coupled with the brothers' substantial control over silver, raised alarms about potential market manipulation. Investigations were initiated to determine whether the Hunts were attempting to distort market prices through their buying spree. This regulatory scrutiny underscored the delicate balance between aggressive investment strategies and the integrity of market operations. The potential for manipulation brought about serious concerns about transparency and fairness in trading. Furthermore, the heightened vigilance by regulators added pressure on the Hunts, indicating that their play for control was not merely an isolated investment strategy, but one with far-reaching implications for market principles and investor confidence. Impact on market dynamics. The Hunts' attempt to control the silver supply precipitated notable volatility within the market. With concerns about their influence growing, other investors reacted defensively, leading to increased market unpredictability. Panic selling ensued as traders, fearing drastic price corrections, rushed to offload their positions, exacerbating the very volatility that the Hunts had inadvertently created. This tumult had a ripple effect throughout the commodities market, fostering an environment of distrust. As prices swung wildly due to speculative actions and reactions, normal trading practices became overshadowed by fear. Investors no longer felt secure in their positions, leading to a passive market where many chose not to engage. This shift marked a significant transformation in how commodities were traded, establishing a precedent for increased caution in future market speculation. Policy changes and fallout. In light of the extraordinary price surges and the chaos surrounding the silver market, regulatory bodies felt compelled to intervene. New rules were introduced. designed to curb excessive speculation and stabilize market conditions. These policy changes fundamentally altered the trading landscape, catching the Hunts off guard as their strategies were suddenly rendered obsolete. The consequences were devastating. In the wake of these new regulations, the Hunts faced an unprecedented market crash, leading to losses exceeding $1 billion on Silver Thursday. This abrupt reversal exposed the pitfalls of leverage and market manipulation, leaving the brothers at a significant disadvantage. The fallout served as a stark reminder of how quickly fortunes can shift in the volatile world of commodities trading, illustrating the risks inherent in attempting to control a market that is subject to external influences beyond one's grasp. The Day of Reckoning, Silver Thursday, March 27, 1980, known as Silver Thursday, was a critical turning point for the Hunt brothers. This section details the events of that day and how leverage magnified their losses. The collapse of silver prices. On Silver Thursday, March 27, 1980, the silver market experienced a catastrophic collapse, with prices plummeting from nearly $50 an ounce to below $11 within a matter of hours. This dramatic fall was predominantly attributed to the Hunt brothers' excessive leverage in their bid to corner the silver market. As they acquired vast quantities of physical silver, the brothers financed much of their purchases through borrowed funds, amplifying their exposure to price fluctuations. The rapid devaluation of silver sent shockwaves through the financial community, with the Hunts' leveraged positions leading to devastating losses estimated at over $1 billion in a single day. The event highlighted the inherent volatility of commodity trading and how leverage can turn bullish strategies into perilous liabilities almost overnight. This scenario serves as a concrete example of how aggressive strategies can backfire, particularly in a market as unpredictable as precious metals. Market reaction. The sharp decline in silver prices triggered a chain reaction of panic among investors across the markets. As news of the Hunts' troubles circulated, many investors rushed to sell their positions, fearing further losses and the potential for a prolonged downturn. This avalanche of selling pressure exacerbated the already rapid decline, driving silver prices down even further. Institutional investors and traders, sensing the instability, began to sharply reduce their exposure to silver, leading to a liquidity crisis. The mass exodus from silver not only contributed to its immediate devaluation, but also instilled a deep sense of fear that rippled through the broader commodities market. Ultimately, this day of reckoning demonstrated how interconnected financial systems can escalate crises, particularly when confidence erodes as quickly as it had been built. Financial fallout for the Hunts. The consequences of Silver Thursday were catastrophic for the Hunt brothers, as they faced staggering losses that effectively threatened their financial solvency. With over $1 billion wiped from their portfolios in just one day, the brothers found themselves on the brink of financial ruin. The excessive leverage they utilized in their silver trading meant that while they could reap unimaginable profits during the market's rise, they equally exposed themselves to relentless risks as prices collapsed. This fallout not only affected the Hunts' wealth, but also had ramifications in the broader financial landscape. Their plight underscored the dangers of speculative trading and excessive borrowing, exemplifying how even billionaire tycoons could be brought to their knees by market volatility. It served as a warning for future investors regarding the importance of risk management in leveraged positions. Long-term implications. The repercussions of Silver Thursday extended far beyond the immediate losses suffered by the Hunts. The chaotic market conditions and resultant panic led regulatory bodies to reassess trading practices and implement significant changes in trading regulations. This included the introduction of new rules aimed at preventing other investors from undertaking similarly risky, unregulated maneuvers that could destabilize entire markets. In the long term, Silver Thursday reshaped how commodities were traded and regulated, emphasizing the need for transparency and risk assessment in financial operations. It served as a catalyst for tighter controls within the commodity markets, helping prevent future market manipulations. Furthermore, it sparked a broader dialogue about the nature of speculative trading and the responsibilities of large investors, ultimately paving the way for a more stable market environment. Chapter 8. Market Manipulation Accusations. As the Hunts continued to amass incredible wealth and influence over the silver market, accusations of market manipulation arose. This chapter discusses these claims and how they reflect broader concerns about fairness and integrity in financial markets, the rise of market manipulation claims. The Hunt brothers' massive silver acquisition did not go unnoticed. As their influence in the market grew, so did the scrutiny from regulators and market participants. This section examines how the onset of accusations regarding market manipulation marked a turning point in the Hunt brothers' silver saga. Emergence of concerns. The Hunts' ambitious strategy to acquire silver prompted an immediate response from the trading community. As their holdings ballooned, market watchers noted a significant uptick in silver prices, moving from a relatively stable range to alarming heights. Traders began to worry that the Hunts' actions were forcing the market dynamics to change, leading to fears of an artificial bubble. This apprehension was amplified by the brothers' well-known status as oil tycoons, raising suspicions that they could manipulate market conditions to their advantage. As their influence grew, calls for regulatory intervention became louder. Many traders feared that the Hunts' relentless pursuit of silver could undermine the integrity of the entire commodities market. This situation ultimately escalated into broader discussions about market manipulation, capturing the attention of financial regulators who felt it imperative to investigate the unprecedented activity in the silver market. Defining market manipulation. Market manipulation encompasses various practices aimed at artificially altering the supply or demand for a commodity, creating misleading appearances in the market. In a typical definition, it refers to actions that distort the fair price discovery process, leading to a disconnect between actual market values and perceived values. This behavior is often viewed as a serious violation of market integrity and fairness. The Hunts' activities were scrutinized under this definition as their massive buying sprees raised concerns among analysts and regulators alike. If a small number of players control a continuous buying spree that influences prices, it fundamentally disrupts the efficiency of market mechanisms. This raised essential questions about ethics in trading and the ramifications of such concentrated control over a critical commodity like silver. The role of regulatory bodies. As the silver market started to show signs of instability, regulatory authorities such as the Commodity Futures Trading Commission began looking into the Hunts' trading practices. The CFTC's mandate allowed it to step in and investigate potential market manipulation, especially when financial markets show volatility indicative of excessive speculation. Their involvement intensified as they sought to protect market integrity and restore investor confidence. The regulatory bodies aimed to determine whether the Hunts were engaging in practices that could destabilize not only the silver market, but also broader economic conditions. This intervention marked a critical turning point in the brothers' operations and intensified the narrative around their aggressive strategy in securing silver. Public sentiment and media coverage. The media played a pivotal role in shaping public sentiment about the Hunts and their influence on the silver market. Initially viewed as savvy investors protecting their wealth, the narrative soon shifted toward framing them as embodiments of greed and ambition. Reports highlighted the enormous wealth they were amassing through strategic silver purchases, nurturing a perception that they were trying to dominate a finite resource. Editorials and news segments often speculated about the implications of their actions, portraying them as a threat to market stability and fairness. This shift in media coverage contributed significantly to the scrutiny the Hunts faced, amplifying calls for investigation and regulation, and ultimately impacting public perception, creating an environment ripe for suspicion and accusations of market manipulation. Strategies behind the accusations. As the tension rose in the silver market, various strategies utilized by the Hunts came under fire. This section focuses on the tactics that raised red flags and how these strategies led to broader accusations of manipulation. Cornering the market. The Hunts' ambition to gain control over the silver market raised eyebrows across the financial landscape. They aimed to acquire a substantial percentage of the available silver, effectively attempting to corner the market. This strategy, while potentially lucrative, caught the attention of regulators and competing traders alike. By accumulating vast amounts of physical silver, the brothers sought to influence prices significantly. Their actions, however, sparked accusations suggesting that they were manipulating market dynamics for personal gain. Critics argued that this behavior undermined the fundamental principles of market economics, where prices should reflect supply and demand rather than the whims of a few wealthy individuals. The Hunts' strategy not only threatened to destabilize the silver market, but also highlighted broader concerns about the ethical implications of such power in the hands of private financiers. Use of leverage. The Hunt brothers employed considerable financial leverage to amplify their betting on silver. By using borrowed funds to purchase silver contracts, they significantly increased their exposure to market fluctuations. This approach heightened not only their potential profits, but also their risks. Leverage, in this case, became a double-edged sword. As silver prices soared, so too did the Hunts' wealth, but the amplified risks became a central concern for market analysts. Their financial maneuvering suggested a dangerous disregard for the inherent volatility of commodity trading. Critics maintained that such heavy reliance on borrowed capital jeopardized the entire market's stability, inviting closer scrutiny from regulatory bodies aiming to protect against excessive risk-taking that could have far-reaching consequences. Interference with market prices. The strategies employed by the Hunts to inflate silver prices led to a contentious debate regarding market integrity. Their purchasing tactics created artificial demand, which distorted natural price movements and led to skepticism about the legitimacy of the marketplace. Traders and analysts began to question whether the Hunts were engaging in legitimate investment practices or whether they were artificially inflating prices for their own benefit. This manipulation raised alarms about the overall health of the commodities market. As the Hunts continued to hoard silver, concerns grew that their tactics could lead to drastic fluctuations that would harm other investors and disrupt market functions. The conflicting interests created a tense atmosphere that highlighted the thin line between aggressive investing and market manipulation. Allegations from competing traders. The Hunts' aggressive strategies did not go unnoticed by rival traders, who quickly voiced their discontent. Accusations of monopolistic behavior became common, with competitors claiming that the Hunts' market influence hindered fair competition. These traders argued that the Hunt brothers' actions stifled opportunities for others and set a dangerous precedent for market dynamics. This outcry from competing traders underscored the broader implications of the Hunts' market involvement. By perceiving the brothers as a threat to equitable trading practices, rivals called for regulatory action to ensure that market operations remained fair and transparent. As the accusations mounted, the calls for increased oversight on market manipulation grew louder, signaling an impending clash between the ambitions of individual investors and the collective interests of the trading community. The impact of Silver Thursday. Silver Thursday, the infamous day of reckoning for the Hunt brothers, showcased the culmination of market manipulation allegations and regulatory responses. This section analyzes the events of that day and their aftermath, immediate fallout. The catastrophic price drop on Silver Thursday, March 27, 1980, resulted in staggering immediate losses for the Hunt brothers. The market had been responding to their aggressive accumulation of silver, which they believed was a hedge against inflation and a devaluation of the dollar. However, the sudden fall from $50 an ounce to below $11 sent shockwaves through the financial world. Traders quickly intensified their scrutiny of the Hunts' tactics, with many alleging that their actions constituted outright market manipulation. This dramatic event reignited fears about the vulnerability of commodities markets and the influence of wealthy individuals. As the reality of the Hunts' losses became apparent, skepticism about their intentions and strategies became pervasive. Traders were not only concerned about the financial implications, but also questioned the broader integrity of the markets that allowed such a situation to unfold. The aftermath of Silver Thursday would haunt the Hunts and become a pivotal moment in the study of market behaviors and ethics. Regulatory reactions. In the wake of Silver Thursday, regulatory bodies like the Commodity Futures Trading Commission moved swiftly to introduce stricter trading rules. The events of that day highlighted significant concerns over market manipulation and the need for enhanced safeguards in commodity trading. New regulations aimed to limit the excessive speculation that had been rampant prior to the collapse. This included measures to decrease leverage in trading and increase transparency in market operations. The CFTC's response was indicative of a broader desire to restore confidence in financial markets. With accusations levied against the Hunts, regulators acknowledged that robust frameworks were necessary to regulate participation by influential entities within commodities markets. This moment emphasized the delicate balance between free market operations and necessary oversight to ensure fairness and integrity in trading practices. Investor panic. The dramatic decline in silver prices on Silver Thursday triggered widespread panic among investors. Many individuals who had invested heavily in silver, either directly or via financial products, were unprepared for such a precipitous drop. The ensuing sense of urgency led investors to sell off their holdings en masse, resulting in further exacerbation of price declines. This frenzied selling spree illustrated how trust could evaporate almost overnight in the face of market volatility. As prices plummeted, the Hunts' precarious position became increasingly untenable, further increasing fears that their market influence would collapse entirely. The ripple effects were not confined to silver alone. Commodities markets across the board were affected, as other investors reconsidered their positions in various markets, leading to increased volatility and uncertainty in numerous sectors. Legacy of Silver Thursday. Silver Thursday became a cautionary tale in the world of finance, particularly regarding the risks associated with market manipulation and the dangers of excessive speculation. The events of that day raised serious questions about the ethical limits of wealth and influence in commodity trading. In the years that followed, the lessons learned from this incident influenced a generation of regulations designed to protect markets from similar manipulation. The legacy of Silver Thursday serves as a reminder that while ambitious endeavors can yield remarkable rewards, they also come with significant risks. The cautionary nature of the Hunt story emphasizes the importance of maintaining market integrity and assures entrepreneurs of the need for vigilant market practices, ensuring that individual initiatives do not jeopardize the fundamental principles of fair trading. The fine line of legal trading. This section explores the thin line between aggressive trading and manipulation as exemplified by the Hunts. It discusses the complexities of legal versus illegal strategies in commodity markets. Understanding what constitutes manipulation. Market manipulation refers to actions designed to artificially influence the price of a commodity or security. In the context of the Hunt's silver trading activities, legal frameworks struggle to clearly define the boundary between aggressive trading strategies and unlawful manipulation. Different jurisdictions may interpret regulations variably, making it challenging for market participants to navigate these gray areas. Under U.S. law, manipulation involves practices that distort the natural supply and demand dynamics. However, aggressive buying, like that of the Hunts, can be seen as merely responding to market conditions. The Hunts argued that their substantial investments were legitimate market forces aimed at securing their wealth against inflation. Nonetheless, critics accused them of attempting to corner the market by accumulating vast quantities of silver, influencing prices through sheer purchasing power. Case studies of market participants. To better understand the scrutiny faced by the Hunts, it is insightful to examine similar high-profile cases in commodity trading. The case of the Hunt brothers is often compared to events like the 2011 silver market rise, where speculation in futures trading drew sharp criticism. Such analyses highlight systemic vulnerabilities within the trading ecosystem and how regulatory bodies react to perceived manipulation. One striking example includes the 2008 oil speculation scenario, where traders leveraging excessive positions attracted regulatory oversight. These cases demonstrate a historical pattern of reaction against aggressive market behaviors, reflecting a broader concern about maintaining orderly markets and protecting less informed investors. Importance of fairness in markets. Fairness in financial markets is paramount to ensure that all participants can compete on a level playing field. Investors lose confidence when they perceive that market manipulation goes unchecked, potentially leading to reduced participation and liquidity. The Hunt saga symbolizes the tension between innovative trading strategies and the ethical obligations traders have toward market integrity. Effective regulation serves as a safeguard against manipulation while fostering an environment where legitimate strategies can thrive. Achieving fairness requires constant vigilance and adaptability from regulatory agencies, ensuring that the rules of engagement evolve alongside market dynamics. Enduring faith in market systems ultimately sustains investor participation and healthy economic growth. Lessons for future traders. The dramatic events surrounding the Hunts provide crucial lessons for future traders. One primary takeaway is the potential repercussions of attempting to exert excessive control over a market. The Hunts' experience is a reminder that while ambition drives profit, it can also lead to devastating losses if the financial landscape shifts unexpectedly. Furthermore, these events underscore the necessity of understanding regulatory environments. Traders must be aware that what may seem like a sound strategy could quickly devolve into manipulation accusations if it draws unwelcome regulatory scrutiny. In essence, balancing aggressive trading with an ethical approach is vital for sustained success in the commodities market. Chapter 9, The Government Response. The increasing control of the silver market by the Hunts prompted governmental scrutiny and intervention. This chapter covers the actions taken by regulatory bodies in response to the Hunts' activities, setting the stage for the fateful day known as Silver Thursday. The build-up of tension. As the Hunts amassed their silver holdings, it became clear that their activities were raising red flags among regulators. The immense pressure on the silver market alerted both government officials and financial institutions to the potential risks of market manipulation. The Hunts' dramatic increase in silver purchases led to unprecedented price spikes. The Hunt brothers' decision to invest heavily in silver resulted in extraordinary price fluctuations. Beginning in the late 1970s, as they initiated their buying spree, silver prices soared from around $6 per ounce to an astounding $50 per ounce by early 1980. This meteoric rise was not merely a reflection of increased demand, but was also tied to the fears of inflation and currency devaluation that gripped the market during this period. To put this into perspective, the price increase created a frenzy among investors, as more people rushed to buy silver, believing it to be a safe haven akin to gold. The brothers' stranglehold on the market drove prices even higher. The Hunts were not just purchasing silver, they were actively altering the landscape of the commodity market, making it a focal point for speculation and investment. Regulatory bodies began monitoring the Hunts' trading patterns closely. As the Hunts' silver accumulation escalated, regulatory bodies such as the Commodity Futures Trading Commission took notice. The sheer volume of their transactions raised alarms about potential market manipulation. Regulators began to scrutinize the Hunts' trading activities, setting up a watchful eye on their operations. This newfound oversight came in response to the growing suspicion that the Hunts were trying to corner the silver market. By holding such a significant share of silver, they risked distorting fair market practices. Their strategy, once seen as brilliant by some, led authorities to be vigilant to ensure the integrity of the market was upheld. Concerns were raised about the integrity of commodity markets amidst rising prices. The dramatic increase in silver prices, largely influenced by the Hunts' activities, prompted widespread concerns about market integrity. As prices skyrocketed, fears grew that the silver market was becoming increasingly vulnerable to manipulation, which could deter legitimate investors. Financial analysts and market watchers began to question whether the Hunts could maintain their stranglehold without creating an artificial bubble. This unease was amplified by discussions in economic circles about the implications of allowing two individuals to control such a substantial share of a critical commodity. As speculation and paranoia mounted, the stage was set for significant regulatory intervention. Public interest and media coverage heightened awareness of the silver market's instability. The Hunts' aggressive silver buying strategy captured the media's attention, leading to extensive coverage of the burgeoning silver crisis. Journalists began reporting on the intricacies of commodity trading and the Hunts' controversial methods, which fanned public interest and concern for the broader economic implications. This heightened awareness of the silver market's volatility led to increased scrutiny from not only regulators, but also from investors seeking safe havens amid economic uncertainty. As stories of the silver bubble spread, they prompted further speculation and fear, ultimately culminating in a dramatic climax on Silver Thursday, where market dynamics would shift drastically. The public's invested interest reflected on the floors of commodity exchanges as everyone awaited an inevitable correction: government investigations. Faced with an escalating situation, government agencies initiated investigations into the Hunts' aggressive market strategies. These inquiries sought to determine whether their actions constituted manipulation or if they were simply savvy investors. The Commodity Futures Trading Commission took the lead in the investigations. The CFTC, established in 1974 to regulate U.S. commodity futures and option markets, quickly recognized the unprecedented nature of the Hunts' silver trading activities. By 1980, the brothers' relentless purchasing drove silver prices to historic highs, prompting concerns about market integrity. The CFTC initiated a thorough investigation to assess whether the Hunts' acquisitions constituted manipulative practices. The CFTC's role was crucial as it wielded the authority to enforce regulations designed to protect the markets from manipulation and abuse. This included examining trading records, interactions with brokers, and the overall impact of the Hunts' actions on the silver market. The findings of the CFTC would not only determine the fate of the Hunt brothers, but also set precedents for how similar market situations might be handled in the future. Regulators scrutinized the possibility of illegal cornering of the silver market. The concept of cornering the market refers to an attempt to gain sufficient control over a commodity to manipulate its price. As the Hunts amassed a staggering amount of silver, concerns grew among regulators about whether their accumulation was a mere investment strategy or a calculated attempt to corner the market. This scrutiny led to intense investigations, as regulators sought to establish the distinction between aggressive trading and illicit market manipulation. The increased control the Hunts had over silver supplies raised alarms within financial circles and government entities, leading to discussions about fairness and transparency within commodity markets. Ultimately, these investigations highlighted the delicate balance between speculative investment and ethical market practices. Investigations highlighted the need for clear regulations on commodity trading. The investigations into the Hunt brothers' activities illuminated significant gaps in regulatory frameworks governing commodity trading. As silver prices soared, the lack of comprehensive guidelines for trading activities became increasingly apparent. This situation raised the question of how to effectively prevent manipulation without stifling legitimate trading. Regulators recognized that the rapid expansion of commodity markets, coupled with technological advancements in trading, required updated policies. They began to advocate for a more nuanced regulatory approach that would address the complexities of modern trading environments. As a result, the inquiries not only scrutinized past events, but also catalyzed discussions on future regulatory reforms aimed at ensuring market integrity. Findings from these inquiries played a critical role in shaping future trading policies. The outcomes of the CFTC's investigations and broader governmental inquiries were pivotal. They established key precedents for how commodity trading would be managed going forward. Findings revealed that the Hunt's activities, whether seen as manipulative or aggressive investing, led to immediate calls for reform in trading practices. Consequently, the regulatory environment evolved to incorporate clearer definitions of market manipulation and established more stringent oversight measures. The lessons learned from the Silver Thursday debacle informed policymakers, ultimately resulting in enhanced regulations designed to protect investors and maintain the integrity of markets against similar speculative excesses in the future. Regulatory actions and measures. In response to the market volatility, regulators implemented new policies aimed at curtailing the Hunt's influence. These measures were designed to protect the market and prevent the monopolization of vital resources like silver. New trading limits were introduced to increase market stability. In the wake of escalating volatility in the silver market, regulatory bodies recognized the need for immediate action. New trading limits were established to curb excessive speculation and to restore balance. These limits were focused on reducing the number of contracts traders could hold, thereby limiting potential market manipulation. The introduction of these restrictions was a direct response to the Hunt's aggressive strategies, which threatened to destabilize not only the silver market but the commodities market as a whole. By capping trading volumes, regulators aimed to ensure a more equitable distribution of silver trading activity among investors. These measures drew mixed reactions. While some applauded the move as necessary for market integrity, others criticized it as an overreach that stifled legitimate trading activity. Nevertheless, the new trading limits were a pivotal step in attempting to safeguard the market's stability during a time of unprecedented speculation. Margin requirements for silver trading were escalated significantly. Alongside trading limits, regulators took significant steps to adjust margin requirements for silver trading. By raising the amount of capital that investors needed to post as a margin for their positions, they sought to mitigate the risk of excessive leverage, which was seen as a critical factor in the Hunt's speculative activities. This increase in margin requirements meant that participants in the silver market needed to invest more of their own money up front. As a result, the financial barrier to entry grew, limiting the number of traders who could engage in high-stakes trading practices that could influence prices unduly. The immediate impact of these changes was profound, as many smaller investors were forced to reduce their positions or exit the market entirely. While the intention was to curtail the Hunt's uncontrolled expansion, the escalation of margin requirements also highlighted the fragile balance between regulation and market accessibility. Regulatory measures aimed to restore investor confidence in the silver market. In the wake of the Hunt's action, restoring investor confidence became paramount for regulatory bodies. The chaotic trading patterns and dramatic price fluctuations had shaken many market participants, resulting in widespread uncertainty. To reestablish trust, regulators undertook several measures that included public communication campaigns to clarify the new rules and their purpose. Emphasizing the need for stability, they aimed to reassure both investors and traders that the integrity of the silver market would be maintained. By implementing these measures, authorities sought to convey that they were committed to a level playing field for all market participants, not just the wealthy few like the Hunt brothers. These regulatory actions were crucial in fostering a renewed sense of security, an essential component for the market's recovery and long-term viability. The changes had immediate effects on the Hunt's operations and their strategies. The regulatory changes instituted in response to the Hunt's market activities had a profound impact on their operational strategies. Faced with new trading limits and increased margin requirements, the brothers were forced to reassess their approach to accumulating silver. Previously, their strategy had relied heavily on leverage and rapid accumulation of silver contracts. However, with stringent regulations in place, they could no longer hold massive positions without incurring significant costs, leading to a swift adaptation in their trading tactics. The Hunts began reducing their positions, motivated by the need to comply with the new market dynamics. This pivot marked a drastic shift in their strategy, emphasizing the importance of flexibility in trading amid changing regulatory landscapes. Ultimately, these changes not only affected their immediate operational strategies, but also contributed to the impending market crash known as Silver Thursday. The role of financial institutions. Major financial institutions reacted strongly to the Hunt's maneuvers in the silver market. As the situation escalated, banks and trading firms focused on assessing their exposure to the Hunt's positions and their strategies for risk management. Institutions began to limit leverage offered to commodity traders. In the wake of the Hunt's aggressive accumulation of silver, financial institutions recognized a critical need to curb the leverage extended to commodity traders. This alteration stemmed from concerns over market volatility and the potential for catastrophic losses that could destabilize not only individual firms but the entire market. By restricting leverage, banks aimed to mitigate risk while encouraging more prudent trading practices within the sector. The implications of these restrictions were significant. Traders who relied on borrowing funds to amplify their investments suddenly found themselves constrained, which in turn decreased speculative trading in silver and related commodities. This shift served as a warning to traders that unchecked leverage could have dire consequences, reminiscent of historical market crises. Consequently, institutions reevaluated their risk tolerance and the thresholds for lending to traders involved in high-stakes commodity investments. Some banks started reassessing their lending practices in light of the Hunt's influence. As the Hunt's maneuvers escalated, banks began a thorough reassessment of their lending practices concerning commodities. The unprecedented market fluctuations highlighted possible vulnerabilities in their portfolios, prompting financial institutions to consider the ramifications of their engagement with high-leverage traders. With the Hunt brothers controlling a considerable share of the silver market, the banks needed to navigate the delicate balance between facilitating customer transactions and safeguarding their financial health. This reassessment often meant tightening credit lines and revisiting collateral requirements. By doing so, banks aimed not only to protect their interests, but also to establish a more wary lending environment that could withstand potential shocks. On a broader scale, the banking sector's response influenced investor sentiment, leading to a more cautious approach among traders and altering the dynamics of commodity trading as fear of systemic risk grew. The financial community was on high alert as the market faced systemic risk. The dramatic escalation of silver prices drew the attention of not only traders and investors, but also regulatory bodies and financial institutions, all of whom sensed the looming systemic risk. As the Hunts exerted their influence over the market, the stability of commodity trading began to hang in the balance. Bankers, traders, and regulators were acutely aware that if the situation spiraled out of control, it could result in a financial crisis that cascading effects across other markets. The heightened anxiety among financial entities led to increased vigilance. Institutions began implementing daily stress tests and reviewing their exposure to commodities trading. An environment of uncertainty prevailed, with many industry players forming coalitions to surveil the market closely. The overarching sentiment reflected a collective recognition that serious intervention might soon be necessary to avert broader financial fallout, setting the stage for the governmental response that would follow. Collaboration among financial entities aimed to devise a collective response to the instability. In light of the growing instability in the silver market, financial institutions started collaborating to address the widening crisis. Recognizing that the Hunt's behavior could pose a threat not only to their individual operations, but to the financial system at large, banks and trading firms sought to share critical information about market exposure and potential risks. This concerted effort included convening meetings among industry leaders to discuss strategies for stabilization. The collaboration extended beyond mere information sharing. It involved a strategic reevaluation of trading practices and risk management strategies. The goal was to create a unified front against the unpredictable fluctuations wrought by the Hunt's speculative purchases. By pooling their resources and insights, these financial entities aimed to formulate a responsive action plan that could protect the integrity of the market and prevent significant disruptions. This unified approach further underscored the urgent need for a coordinated response to what was becoming an increasingly untenable market situation. The final days leading to Silver Thursday. As the pressure mounted, the countdown to Silver Thursday began. Government actions and market responses created a tense atmosphere, unsustained, able for the Hunts and their ambitions. Heightened volatility suggested an imminent market correction. In the days leading up to Silver Thursday, the silver market experienced unprecedented volatility. Prices witnessed drastic fluctuations, indicative of a brewing storm. Traders observed sharp spikes and steep declines, raising concerns that a market correction was not just possible, but impending.
This instability was exacerbated by the Hunt's aggressive purchases, which had initially driven prices skyward from $6 to $50 an ounce.
Market analysts noted that the tremors of volatility often precede significant adjustments, hinting at a market that could not sustain the artificial inflation created by the Hunt's buying spree. Many investors began hedging their bets, selling off silver in anticipation of a downturn. This behavior contributed to the heightened anxiety in the market, creating a ripple effect that ultimately fueled uncertainty among even the most seasoned traders. The Hunts were under increasing financial pressure from mounting debts. As the Hunt brothers continued their quest to corner the silver market, their financial commitments began to balloon. The extensive leverage they employed to purchase vast quantities of silver meant they were not just risking their oil fortunes, but also incurring massive debts. Reports indicated that their liabilities soared, surpassing $1 billion, as they relied on margin loans to fund their silver investments. This financial pressure created an unsustainable situation for the Hunts. As market volatility increased, their debt obligations could quickly spiral out of control. Financial analysts cautioned that the brothers were operating on borrowed time. If the silver market corrected, their leveraged position could lead to catastrophic losses. This financial strain was palpable in the air, contributing to the increasing tension in the markets. Signs of panic began to surface among investors and traders alike. With the looming threat of market correction, signs of panic began to permeate through trading floors as investors reacted to the uncertainty surrounding silver prices. Many traders started selling off their positions, fearing a loss that would follow the Hunt's potential fall from grace. Sudden sell-offs evidenced a shift in sentiment. Confidence started to erode as the possibility of a collapse became more tangible. Market participants, once enthusiastic about silver, began to question the sustainability of the Hunt brothers' strategy. The mood swiftly transitioned from speculative excitement to one of dread. News of mounting debt, pressures, and unstable prices led to a frantic race to liquidate assets, creating a downward spiral that further intensified market stress. Rumors circulated regarding potential government interventions, further destabilizing the market. As tensions escalated, whispers of possible government intervention began to circulate among traders and brokers. Speculation about official actions, including the implementation of new regulations or emergency measures, sent shivers through the silver market. Some believed that increased scrutiny could lead to restrictions on trading, further constricting liquidity and pushing prices downward. This atmospheric turmoil was compounded by a growing distrust in the Hunts' ability to maintain their silver empire. Accusational murmurings grew louder, suggesting that the brothers' ambitions had exceeded prudent limits, which only intensified fears of impending legislation. As rumors surged, the market responded with greater volatility, making panic a self-fulfilling prophecy as traders scrambled to adapt to a rapidly shifting landscape. The lessons learned. The government's response to the Hunt strategy taught valuable lessons in market regulation and the importance of oversight in commodity trading. These developments not only impacted the silver market, but also reshaped how investors approach commodities in the future. The importance of regulatory vigilance became clear in preventing market manipulation. The events surrounding the Hunt brothers and their aggressive silver buying strategies underscored the critical role of regulatory vigilance in financial markets. As the Hunts amassed a substantial portion of the world's silver supply, concerns grew about the potential for price manipulation. This situation prompted regulatory bodies, particularly the Commodity Futures Trading Commission, to explore the limits of their authority in overseeing commodity trading. Regulatory interventions are essential to maintain market integrity and protect investors from the consequences of monopolistic practices. The collapse of silver prices on Silver Thursday served as a stark reminder that unchecked market power can lead to devastating outcomes, not just for individual investors, but for the entire financial system. Market dynamics highlighted the significance of diverse strategies among investors, learning reading speed 69%. The drastic fluctuations in silver prices during the Hunt brothers era emphasized the necessity for investors to employ diverse strategies. While the Hunts concentrated their efforts on accumulating physical silver, other market participants began to adopt varied approaches to mitigate risk. This diversification became crucial as it allowed investors to hedge against volatility and market downturns. Investors learned the importance of not putting all their eggs in one basket. Instead, creating a portfolio that included multiple asset classes can cushion against sudden market shocks. The silver crisis ultimately provided a valuable lesson in the need for adaptable investment strategies in the face of government interventions and market corrections. Lessons from Silver Thursday influenced future legislation in commodity markets. The remarkable events of Silver Thursday catalyzed significant changes in legislation regarding commodity markets. In the aftermath, Lawmakers recognized the risks associated with concentrated holdings and market manipulation. This led to new rules and regulations aimed at increasing transparency and limiting the amount of single-entity control over commodities. Such legislation has continued to evolve as governments strive to ensure equitable access to markets and prevent any single player from potentially destabilizing a commodity's value. These regulatory reforms serve as a demonstration of how past market abuses can shape the future landscape, promoting a more robust and resilient trading environment. The silver crisis demonstrated the risks posed by concentrated market power. The Hunt brothers' attempt to corner the silver market vividly illustrated the dangers of concentrated market power. With over a third of the world's privately held silver under their control, the Hunts inadvertently showcased how vulnerable markets can be to the actions of a few influential players. This concentration created an artificial inflation of prices that ultimately proved unsustainable. The crisis revealed that when a single entity or a small group of entities controls a significant portion of a market, they can create severe inequities and volatility. Moving forward, this scenario has highlighted the necessity for regulations curbing excessive holdings to prevent similar market crises in the future. This lesson continues to influence how markets are monitored and regulated today. Chapter 10, Silver Thursday, The Collapse. March 27, 1980, is etched in financial history as Silver Thursday. This chapter recounts the events of this tumultuous day, detailing the sudden shifts in market rules and the devastating impact on the Hunt brothers' fortunes. The build-up to Silver Thursday, leading up to March 27, 1980, the conditions for a financial storm were ripe. The Hunt brothers had orchestrated an immense accumulation of silver, and the market reacted dramatically. This section explores the events that built anticipation for the collapse on Silver Thursday, massive accumulation. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, engaged in one of the most audacious financial strategies of the late 20th century. They successfully amassed over 100 million ounces of silver, an impressive feat that was aimed at cornering the market entirely. This formidable collection represented approximately one-third of the entire world's private silver supply at that time. This accumulation did not happen overnight. It was built over several months of strategic buying that sparked both fear and intrigue in the financial markets. The brothers believed that by holding such a vast quantity of silver, they could manipulate its price to unprecedented heights, shielding themselves from inflation and potential economic collapse. However, this massive accumulation also attracted scrutiny from regulators and other market participants, setting the stage for a showdown that would ultimately lead to their downfall. Fear of inflation. In the late 1970s, the United States faced significant economic challenges, with rampant inflation undermining public confidence in the dollar. This climate of instability prompted investors to seek refuge in tangible assets, particularly precious metals like silver. The threat of ongoing inflation drove many individuals and institutions to accumulate silver as a hedge against the devaluation of paper currency. The Hunt brothers capitalized on this anxiety, promoting silver as a secure and appreciating investment. Their actions intensified the demand for silver, creating a self-fulfilling prophecy that further accelerated their buying spree. As prices began to rise, the allure of silver attracted a wider range of speculative investors, transforming the metal from a traditionally stable asset into a highly volatile financial instrument, priming the market for the impending crisis known as Silver Thursday. Market speculation. As silver prices soared, the market began to attract a wave of speculators who viewed the rising prices as an opportunity for substantial profit. This speculative buying frenzy turned the silver market into a highly lucrative arena, pulling in a diverse array of investors, from individuals to institutional funds. The frenzy not only inflated the price of silver, but also created an atmosphere of greed and anticipation. The presence of speculators transformed the market dynamics, introducing a level of unpredictability that further complicated the landscape. Many investors were drawn to silver, seeing it as a quick route to riches amidst an uncertain economic backdrop. As these speculators piled into the market, they unknowingly contributed to the creation of a financial bubble that would have devastating consequences, culminating in the crisis on Silver Thursday when the market drastically reversed course. Price run up. The concerted efforts of the Hunt brothers and the influx of speculative investments culminated in a dramatic price run-up in silver. What began as a modest price of around $6 per ounce surged to nearly $50 per ounce by early 1980, capturing the world's attention. This meteoric rise not only highlighted the volatility and potential of the silver market, but also drew media scrutiny and public fascination. News stories abounded, painting the Hunt brothers as both heroes and villains in their quest to dominate the silver market. The price run-up created a psychological effect, encouraging even more investors to buy, thus further inflating prices. As the silver market peaked, Many began to question the sustainability of such an unprecedented rise, setting the stage for a market correction that would arrive all too swiftly on Silver Thursday. The shift in market regulations. On Silver Thursday, sudden changes in trading regulations catalyzed a dramatic turn in the market. This section discusses the authorities' response to the Hunt brothers' tactics and the rules that were intended to stabilize the market. Government intervention. On Silver Thursday, the financial world witnessed unprecedented intervention by the government, particularly from the Commodity Futures Trading Commission. In an effort to stabilize the tumultuous silver market, the CFTC introduced stricter margin requirements for trading silver futures. This move was catalyzed by the dramatic price surges driven by the Hunt brothers, who aimed to corner the silver market. The CFTC's regulations sought to curb speculative trading activities that could exacerbate the already volatile market conditions. This intervention was not merely a response to prices climbing unsustainably, but also a protective measure against larger economic consequences. The fear was that a collapse of silver prices could lead to broader instability in financial markets. By increasing margin requirements, the CFTC attempted to lessen speculative pressure and restore order to a market spiraling out of control. However, this decisive action led to unforeseen reactions among traders and investors alike. Response to volatility. The extreme volatility in the silver market during the late 1970s prompted regulators to act decisively. With prices soaring from around $6 to nearly $50 an ounce, the economic implications of such rapid fluctuations caught the attention of financial authorities. Concerns were mounting that a sudden crash could have harsh repercussions not only for investors but for the overall economy, potentially triggering a market-wide panic. To mitigate this risk, regulators feared that without intervention, the speculative trading activities that had driven prices to such heights could lead to a catastrophic collapse. As a result, the implementation of new trading rules was perceived as necessary to stabilize the market and protect investors. Unfortunately, these regulations were met with resistance and confusion from market participants, who were left reeling from the abrupt changes. Margin call controversy. The increased margin requirements imposed that fateful day led to a widespread margin call controversy, affecting countless traders across the silver market. Margin calls occur when brokers demand that traders deposit additional funds to maintain their trading positions, a practice that became common as the CFTC elevated margins. Many traders, unprepared for such demands, were forced to liquidate their positions at unfavorable prices. This forced selling not only contributed to the rapid decline in silver prices, but it also amplified existing market panic. As traders scrambled to sell their holdings, the liquidity of the silver market diminished, resulting in a cascade of declining price points. The fallout from these margin calls underscored the precarious balance in commodity trading during periods of volatility and deepened the financial distress experienced by the Hunt brothers and their supporters. Impact on trust. The sudden changes in market regulations on Silver Thursday had a profound impact on investor confidence, fundamentally undermining trust in the silver market. For many investors, the abrupt intervention by government authorities served as a stark reminder of the risks associated with trading commodities. The perception that market forces could be so readily influenced by regulatory changes fostered an environment of uncertainty. As panic swept through the markets, investors began to question the stability of not only silver, but other commodities as well. Trust, once a cornerstone of market participation, began to erode as the acrimony of forced sales and regulatory shifts took their toll. This loss of confidence not only precipitated immediate financial losses for the Hunt brothers, but also set a cautionary precedent for investors in the commodity trading landscape. The Day of Reckoning. March 27, 1980, was a day that unfolded with unexpected chaos. As panic gripped traders and prices plummeted, the consequences for the Hunt brothers became apparent. This section paints a picture of the heartbreak and chaos that defined Silver Thursday. Market collapse. On March 27, 1980, the silver market experienced a catastrophic collapse which sent shockwaves through the financial world. Silver prices plunged dramatically, falling from an astonishing $50 per ounce to around $11 within just a few hours. This unprecedented drop was not just a simple market adjustment, it was a visceral response to panic as traders scrambled to liquidate positions amid the chaos. The swift decline reflected the market's sensitivity to regulatory changes and the lack of liquidity that characterized the trading environment that day. Triggers included governmental maneuvers aimed at controlling speculative excesses, which turned the day into a financial nightmare. This collapse highlighted the volatility inherent in commodity trading and served as a reminder of the risks involved when one segment of the market is artificially manipulated. Hunt brothers' losses. The consequences of the market collapse were devastating for the Hunt brothers, who experienced staggering financial losses exceeding $1 billion. This single trading session not only decimated their wealth, but also fundamentally altered their standing in the financial community. The shock of losing so much wealth sent ripples through their vast network of ventures and investments. Before Silver Thursday, the Hunts had commanded immense power over silver prices, effectively trying to monopolize the market. However, the consequences of their high-stakes gamble were catastrophic. This heavy financial loss was not just a number on a ledger, it represented the collapse of their ambitious plans to control the silver market and a pivotal shift in their business strategies. Emotional toll. The financial disaster of Silver Thursday exacted an emotional toll far greater than mere monetary losses for Bunker and William Hunt. These Texas oil magnates, who had once basked in the thrill of their market manipulation, now faced the grim reality of their dreams unraveling. The humiliation of their public defeat weighed heavily on them, transforming the brothers' ambitious aspirations into stark regret. This day marked a turning point, signaling not only the end of their market dominance, but also a re-evaluation of their risk appetite and business approach. The brothers' emotional struggles wrestled with feelings of despair and betrayal as they realized just how quickly fortunes can change in the volatile world of finance. Their once unbreakable confidence was shattered, leaving them to grapple with a loss that extended beyond wealth. Public reaction. The rapid decline in silver prices on Silver Thursday did not occur in isolation. It resonated deeply with a wide audience, triggering a wave of public reaction that swept across the globe. Investors and ordinary citizens alike were taken aback by the suddenness of the collapse, which drew extensive media coverage and sparked widespread commentary on the implications for the global economy. The event served as a cautionary tale about market manipulation and the fragility of perceived wealth. Analysts and financial commentators dissected the events of that day in detail, warning of the consequences of speculation and the risks that accompany significant financial gambles. The Hunts became icons of hubris, representing the dark side of ambition and greed in a world driven by the relentless pursuit of wealth. Lessons learned from Silver Thursday. The fallout from Silver Thursday provides valuable insights into market dynamics, human psychology, and regulatory responses. This section discusses the lessons that entrepreneurs and investors can draw from this moment in history. Risks of leverage. Leveraging allows investors to use borrowed funds to amplify potential returns. However, this approach carries an inherent risk, as demonstrated dramatically on Silver Thursday. The Hunt brothers' bid to corner the silver market involved significant leverage, which ultimately magnified their losses when the market turned against them. In volatile markets, high leverage can turn impressive gains into staggering losses in a matter of moments. When the price of silver soared to $50 an ounce, the Hunts felt invincible, however. The combination of heavy borrowing and shifting market conditions proved disastrous. Investors must understand that while leverage can enhance gains, it also exponentially increases the risk of significant financial ruin. This cautionary tale underscores the importance of risk management when utilizing leverage. Successful traders and entrepreneurs should evaluate their risk tolerance and set strict limits on their use of borrowed capital, especially in unpredictable market environments. Adaptability in trading. The financial markets are subject to rapid changes, whether due to economic conditions, regulatory shifts, or global events. The Hunts' experience illustrates the paramount importance of adaptability in trading strategies. On Silver Thursday, unexpected changes in trading rules by the government halted the Hunt strategy and caught them off guard. Successful traders must not only prepare for standard market risks, but also be ready to pivot in response to sudden regulatory changes. This flexibility can mean the difference between capitalizing on a market opportunity and suffering substantial losses. Entrepreneurs should consider developing contingency plans that account for various scenarios to stay resilient amidst market fluctuations. Remaining informed about regulatory environments and fostering a culture of quick decision-making can empower traders to navigate uncertainties with confidence. Understanding market psychology. Market moves are often dictated more by trader sentiment and psychology than by underlying fundamentals. The events of Silver Thursday highlighted how fear and greed can create extreme volatility. During its ascent, many speculated that the market was invincible, fueled by the Hunt brothers' aggressive buying tactics, which created an atmosphere of heightened greed. However, when the market turned and panic set in, the Hunts faced a harsh reality. Understanding market psychology is crucial for entrepreneurs and investors alike. Recognizing patterns of fear and greed can help them make better-informed trading decisions and anticipate potential market corrections. Long-term versus short-term strategies. Silver Thursday serves as a stark reminder of the difficulty in balancing short-term trading dynamics with long-term investment strategies. The Hunt brothers' focus on rapidly accumulating silver for immediate gain blinded them to the potential long-term implications of their actions. While it's tempting to chase high returns quickly, the volatility witnessed during this period illustrates the necessity of having a defined investment strategy that accommodates both short-term and long-term goals. Investors should carefully assess their positions, balancing the desire for immediate profits against the realities of potential losses due to short-term market fluctuations. Chapter 11, Aftermath and Financial Ruin. Following Silver Thursday, the fallout was significant for both the silver market and the Hunt brothers. This chapter discusses the rapid decline of their assets and the long-term implications it had on their financial standing and personal lives. The immediate aftermath. Silver Thursday marked a turning point not only for the Hunt brothers, but for the entire silver market. The immediate fallout was drastic, resulting in a rapid decline in silver prices and the Hunt's assets. 1. Market reaction. After the trading rules changed on Silver Thursday, the silver market experienced a catastrophic reaction. Prices, which had soared to an astonishing $50 per ounce due to the Hunt's aggressive buying, began an astonishing freefall. Within a few short months, the price of silver collapsed to under $10 an ounce. This drastic decline was largely a result of panic selling triggered by the new regulations imposed by the Commodity Futures Trading Commission. The sudden shift in market dynamics not only reflected the vulnerability of commodities to manipulation, but also highlighted the high stakes of leveraged trading strategies. Investors around the globe watched in disbelief as the Hunts, once viewed as the kings of the silver market, saw their empire crumble before their eyes. The volatility that ensued created a chilling environment for commodity trading, leaving many to question the integrity and stability of the financial markets. 2. Financial losses. The aftermath of Silver Thursday brought devastating financial repercussions for the Hunt brothers. Their estimated net worth, once in the billions, evaporated almost overnight as silver prices plummeted. Analysts estimated that the Hunt sustained losses exceeding $1 billion in a single day, a figure that illustrated the catastrophic impact of their speculative strategy. This dramatic financial decline not only affected the brothers' wealth, but also had broader implications for their business ventures. The leverage they had utilized to corner the silver market left them deeply exposed when the market reversed. The financial institutions that had supported them were suddenly unwilling to tolerate any further risk, exacerbating their losses and sending shockwaves through their enterprise. 3. Broker relationships. The fallout from the Hunt brothers' failed silver transactions significantly soured their relationships with brokers. As market turmoil escalated and collateral calls multiplied, brokers grew increasingly distrustful of the Hunt's financial stability. The very foundation of their trading partnerships crumbled, leaving the brothers isolated in an environment that had once embraced them. Many brokers withdrew their support or demanded harsh terms in response to the growing uncertainty surrounding the Hunt's ability to deliver on their commitments. This breakdown in relationships not only curtailed their trading activities, but also tarnished the Hunt's reputations in the financial community, making it difficult for them to regain footing amidst the chaos. Ultimately, the erosion of trust with brokers left the brothers facing a stark future regarding their ability to navigate the turbulent waters of the finance world. 4. Psychological impact. The emotional and psychological toll of Silver Thursday on Bunker and Herbert Hunt was profound. Once hailed as successful financial moguls, they faced the harrowing experience of watching their fortunes and reputations implode. The transition from affluence and influence to massive debts and public scrutiny took a significant toll on their mental health. As the dust settled, feelings of despair, stress, and heightened anxiety permeated their lives. The brothers were confronted with not just financial ruin, but the loss of status that defined their identities. This dramatic shift forced them to grapple with the consequences of their ambitious attempts at market manipulation and the hubris that had fueled their rise in the first place. The repercussions of Silver Thursday would haunt them for years, fundamentally altering their personal and professional trajectories. Legal consequences. The fallout from Silver Thursday did not end with financial ruin. Legal troubles compounded the challenges facing the Hunt brothers, adding layers of complexity to their already dire situation. 1. Investigations. In the wake of Silver Thursday, the Commodity Futures Trading Commission launched extensive investigations into the trading practices of the Hunt brothers. Central to these inquiries was the allegation of market manipulation, as the Hunts had significantly influenced silver prices through their aggressive buying strategy. The CFTC sought to determine whether the brothers' actions violated any trading laws or regulations. This scrutiny not only included analyzing transaction records, but also involved interviewing key market participants. The investigations examined the mechanisms the Hunts employed to amass their silver inventory, which amounted to over one-third of the world's private supply. The resulting findings underscored the potential vulnerabilities in the regulatory framework governing commodity trading. As the CFTC delved deeper, the legal implications of the Hunts' speculative strategies became increasingly significant, ultimately leading to calls for stricter oversight in the commodities market. 2. Lawsuits. In the aftermath of their financial debacle, the Hunt brothers faced multiple lawsuits from banks and individual investors who sought to recover their losses. These suits were primarily driven by claims of negligence and perceived deceit in the Hunts' trading activities. The scale of these legal challenges complicated the Hunts' already precarious financial situation, draining precious resources as they engaged in protracted legal battles. The lawsuits brought to light the immense ripple effect triggered by the brothers' attempt to corner the silver market. Additionally, as their prominence diminished, they became symbols of reckless speculation in financial circles. The legal pressures reflected a broader distrust towards individuals who engage in aggressive commodity trading, ultimately leading to heightened scrutiny and caution among investors in subsequent years. 3. Regulation changes. The dramatic events surrounding Silver Thursday prompted significant changes in commodity trading regulations. Lawmakers and regulatory bodies recognized the urgent need to prevent similar occurrences in the future. As a direct response, the CFTC implemented tighter regulations aimed at safeguarding the integrity of the silver market and other commodities. These regulatory changes included new limits on the number of contracts traders could hold and enhanced monitoring of trading activities. The objective was not only to deter market manipulation, but also to instill greater confidence among investors. The Hunts' actions ultimately served as a catalyst for reform, highlighting the delicate balance between speculative trading and market stability. 4. Criminal charges. 1 minute left in chapter. Despite the mounting legal and regulatory challenges they faced, the Hunt brothers ultimately did not confront criminal charges related to their trading practices. However, the absence of criminal proceedings did not mitigate the damage done to their reputations. The perception of their actions as reckless and manipulative lingered, casting long shadows over their future business endeavors. In the financial world, reputation is crucial, and once tarnished, it can be challenging to repair. The Hunts found that the loss of trust significantly impacted their ability to engage in new ventures and attract investors. While they avoided jail time, the reputational damage was a form of punishment in itself, reminding them and others in the industry of the thin line between ambition and greed. Impact on the silver market. The ripple effects of the Hunts' actions altered the dynamics of the silver market for years to come, reshaping how commodities are traded and valued. 1. Market volatility. The actions of the Hunt brothers caused a seismic shift in the silver market, resulting in unprecedented volatility. Prior to their aggressive buying, silver was relatively stable, but as the Hunts accumulated vast quantities, the price surged dramatically from $6 to $50 an ounce. This volatility instilled fear in many investors and traders, who began to perceive silver as a high-risk asset. Factors contributing to this volatility were not only the brothers' trading strategies, but also the governmental reactions to curb their influence on the market. The effect rippled through trading floors globally, as instant fluctuations became commonplace. Subsequently, investors began to question the reliability of silver as a safe haven asset, often used for hedging against inflation. This rampant unpredictability created an environment of caution, as market participants became hesitant, significantly altering how silver was traded and perceived in the financial community. 2. Supply and demand shifts. The drastic actions taken by the Hunt brothers led to significant shifts in silver supply and demand dynamics, as they attempted to offload significant quantities of silver to cover debts following the market crash on Silver Thursday. The sudden influx of metal into the market overwhelmed buyers. This forced many market participants to reassess their demand expectations. With the market suddenly flooded with silver, prices plummeted, altering the fundamental relationship between supply and demand that had existed before the Hunts' manipulative tactics. In the years following 1980, the market struggled to find equilibrium, as the aftermath of the Hunts' strategies caused investors to remain skeptical. The uncertainty surrounding supply levels resulted in fluctuations that would influence pricing structures and investment strategies across the silver market for years to come. 3. Investor sentiment. The fallout from Silver Thursday severely impacted investor sentiment toward silver, leading to a noticeable decline in holdings among both individual and institutional investors. Prior to the Hunts' actions, silver was often viewed as a strategic asset for wealth preservation amid economic instability. Many turned to more stable investment options, leading to a significant decrease in silver holdings. This erosion of trust and confidence marked a pivotal moment in silver's investment narrative, and it took many years of stabilization and recovery for investor sentiment to begin to shift positively once more. 4. Long-term trends. The dramatic events of Silver Thursday initiated a prolonged decline in silver prices, setting negative long-term trends that would echo well into the 1990s. Post-crash, the market faced enduring skepticism regarding silver as a viable asset, with prices stagnating as investor interest waned. For the next decade, silver saw a diminished role as a commodity, suffering from reduced demand and heightened volatility. The regulatory responses and increased distrust created an environment where long-term investment strategies shifted away from silver, affecting its perceived value across markets worldwide. Consequently, the dynamics of silver trading were altered permanently. Prices would fluctuate but seldom regain the highs experienced during the Hunt brothers' speculative bubble. This chapter in silver's history serves as a stark reminder of how market manipulation can lead to extended consequences, impacting investor attitudes and market behavior for years to come. Personal lives and legacy. The financial collapse led to significant changes in the personal lives of Bunker and Herbert Hunt, affecting their relationships and public perceptions. 1. Family dynamics. The financial turmoil that followed Silver Thursday placed immense stress on the personal lives of Bunker and Herbert Hunt. The brothers, once revered as powerful tycoons, found their family relationships strained under the weight of their collective burden. Their monumental losses led to increased tension not only between the two brothers, but also within their extended families. As they grappled with financial ruin, their familial bonds were tested. Relationships began to unravel, as shared dreams of wealth and success were replaced with anxiety and uncertainty. Conversations that once revolved around plans for expansion shifted toward survival tactics. This stress not only impacted their marriages and sibling dynamics, but also influenced their interactions with children and relatives. Ultimately, the quest for silver that once united the Hunt family transformed into a source of division as differing views on how to handle the fallout emerged. The legacy of their financial decisions thus extended far beyond the markets, affecting the emotional landscape of their family for years to come. 2. Loss of public image. The swift transition from billionaires to pariahs was astonishing for Bunker and Herbert Hunt. Their public image, once pristine and celebrated, became tarnished almost overnight. The brothers went from being hailed as visionary investors to being scrutinized as emblematic of greed and market manipulation. Media coverage intensified, painting them as reckless speculators whose hubris brought devastation not only to themselves but also to the silver market and countless investors. The Hunts, who had enjoyed lavish lifestyles and public admiration, now faced public scorn and scrutiny. This sharp decline in their reputation marked a profound shift in their social circles and opportunities. The impact on their public persona lingered long after the financial collapse, as the narrative of their failure became ingrained in discussions about ethics and finance. Their cautionary tale serves as a significant reminder of how quickly fortune can change in the volatile world of commodity trading. 3. Future ventures. In the aftermath of their financial disaster, both Bunker and Herbert sought to rebuild their fortunes through new business ventures. They explored various industries, hoping to leverage their remaining assets to regain some semblance of their former success. However, the market's perception of them as failed speculators heavily influenced their ability to secure favorable terms. Despite their previous wealth and experience, the brothers faced significant challenges in attracting investors and partners. Opportunities that once flowed to them became scarce as their reputation for market manipulation lingered in the background. New ventures were often met with skepticism, curtailing their efforts and limiting their potential for recovery. Ultimately, their attempts to emerge from the ashes of Silver Thursday became a series of uphill battles. Their stories serve to illustrate the harsh realities faced by individuals accustomed to great wealth, now navigating a landscape informed by caution rather than ambition. 4. Lasting impact on legacy. The saga of Bunker and Herbert Hunt evolved into a cautionary tale, illustrating the pitfalls of unchecked greed and the consequences of attempting to corner a market. Their efforts to dominate the silver market are still studied today as prime examples of market manipulation and its inherent risks. This legacy is far from flattering, transforming their once glamorous existence into a narrative embedded in financial lore. Future entrepreneurs and investors often recount the Hunt brothers' story as a stark lesson on the dangers of ambition without ethical considerations. The immense consequences of their actions reverberated throughout financial systems, serving as a reminder of the responsibilities that accompany wealth and power. Ultimately, their fall from grace reshaped discussions around market regulation, ethics in trading, and the responsibilities of investors. As a lasting impact, the Hunt story continues to resonate, illustrating how ambition, if unchecked by ethical boundaries, can lead to both personal and communal catastrophe. Chapter 12, Lessons Learned from the Silver Squeeze. The saga of the Hunt brothers offers critical lessons in market dynamics, greed, and regulation. This concluding chapter summarizes these lessons and reflects on how they apply not only to finance, but to entrepreneurship and investment strategies today. Understanding market dynamics. The Hunt brothers' attempt to corner the silver market serves as an illustration of complex market dynamics. Understanding these dynamics is crucial for any entrepreneur looking to navigate financial landscapes effectively. Market forces are unpredictable. The Hunt brothers' venture into the silver market exemplifies the inherent unpredictability of market forces. Even the most calculated strategies can falter in the face of unknown variables. The Hunts believed they could take control of the silver market, driven by their perception of looming inflation and a declining dollar. However, they underestimated the market's responsiveness to external influences, such as government regulations and global economic shifts. This unpredictability serves as a reminder for entrepreneurs and investors alike. It underscores the importance of conducting thorough market research and staying informed about global economic indicators. While one may craft a well-thought-out plan, factors beyond personal control frequently dictate market trajectories. A robust strategy thus should include contingencies for unexpected developments, allowing for agility and adaptability when the market dynamics shift. Anomalies in supply and demand can lead to extreme volatility. The Hunt brothers' actions led to a dramatic anomaly in the silver market. By acquiring massive quantities of physical silver, they created a scenario where demand far outstripped typical consumption patterns. This imbalance resulted in extreme price volatility, pushing silver from $6 to an astonishing $50 per ounce, reflecting not just value, but speculative enthusiasm. For entrepreneurs, this volatility emphasizes the critical need to grasp the nuances of supply and demand relationships. Understanding how external influences can disrupt these fundamentals is key to risk management. Markets can behave irrationally, influenced by factors such as media narratives or investor sentiment, ultimately leading to dramatic price corrections. Acknowledging this can help guide decision-making processes, encouraging a focus on sustainable growth rather than short-term gains. Understanding how price manipulation can impact market behavior is essential. The Hunts' attempt to monopolize the silver market is a classic example of price manipulation. Their strategy not only aimed to drive prices upward, but also inadvertently highlighted the repercussions such actions have on broader market behaviors. When markets perceive manipulation, they often react with skepticism, leading to increased volatility and eventual corrective measures. For entrepreneurs, recognizing the signals of price manipulation is vital. It's essential to maintain integrity and transparency in business practices. Understanding the externalities surrounding your market sector can provide insights into price behaviors and investor reactions. As history has shown, attempts to manipulate markets typically lead to swift regulatory responses and market corrections, which can be detrimental to long-term business health. Regulations can shift with market conditions, changing the playing field. The Silver Thursday incident illustrates how regulatory frameworks can pivot in response to market conditions. When the Hunts' actions led to uncontrolled market rises, regulatory bodies quickly intervened to restore stability, altering the trading environment they operated within. Such shifts can dramatically affect market strategies and outcomes. For entrepreneurs, the lesson is clear. It is imperative to stay vigilant regarding regulatory changes. Markets are not static, and being aware of potential shifts in legal frameworks can provide a significant advantage. Additionally, understanding the rationale behind regulations can drive more informed decisions, ensuring that businesses not only comply, but can also adapt to leverage these regulations favorably in pursuit of growth. The role of greed in decision-making. Greed played a significant role in the Hunt brothers' strategy. This section reflects on how greed impacts financial decisions and can lead to significant risks. Greed can cloud judgment and lead to overexposure in risky investments. Greed is a powerful motivator in the world of finance, often blurring the lines of rational decision-making. For the Hunt brothers, the driving force behind their silver acquisition strategy was a desire for wealth and power. This pervasive greed led them to accumulate massive positions in silver, representing more than 1/3 of the world's supply at one point. However, this insatiable thirst for profit also clouded their judgment. Their overexposure to a single asset made their financial health precarious, exposing them to significant risks as market conditions shifted. Investors must recognize the dangers of greed, understanding that while ambition can drive innovation and success, unchecked greed can precipitate devastating financial consequences. Emotional decision-making often overlooks critical risk assessments. The emotional highs and lows experienced by the Hunt brothers during their silver investment saga exemplify how sentiment can distort decision-making. As silver prices skyrocketed, the emotions of euphoria and excitement encouraged them to double down on their strategy, ignoring vital risk assessments. When future assessments were based on hope and market optimism, rather than sound analysis, it led to an inability to respond effectively to changing market dynamics. Entrepreneurs must strive to make decisions grounded in data and clear risk evaluations, recognizing that emotional biases can lead to costly oversights. Long-term strategies should prioritize sustainable growth over quick wins. The Hunt brothers' approach to silver trading showcased their focus on quick gains rather than sustainable growth. Their aggressive strategy prioritized immediate profit potential over understanding market fundamentals. While their initial success created wealth, it ultimately resulted in catastrophic losses. To cultivate resilience in investment strategies, entrepreneurs should seek long-term stability and growth instead of seeking rapid, high-risk returns. By fostering an environment of sustainable practices, they can build businesses that are adaptable and robust, reducing the likelihood of catastrophic failures due to market volatility. Learning from past mistakes can help in avoiding future pitfalls. The downfall of the Hunt brothers offers invaluable lessons for investors aiming to avoid similar pitfalls. Their story serves as a stark reminder of the consequences of excessive greed, lack of diversification, and emotional decision-making in financial strategies. Understanding and analyzing these mistakes can empower entrepreneurs to make better choices moving forward. 1 minute left in chapter. By reflecting on the missteps of the Hunts and others, individuals can develop a cautious yet proactive approach to investing. Learning from history enables entrepreneurs to identify warning signs and adjust their strategies, ultimately fostering a culture of responsible investment that prioritizes long-term success over fleeting financial gains. The consequences of market manipulation. The consequences of attempting to manipulate a market can be severe, as seen on Silver Thursday. This section discusses the fallout that can occur from unethical practices. Market manipulation erodes the foundation of trust that is essential for healthy trading environments. When individuals or entities attempt to artificially influence market prices, it creates an uneven playing field. Investors rely on the belief that prices reflect true supply and demand dynamics. In the case of the Hunt brothers, their efforts to corner the silver market not only raised ethical questions, but also led to skepticism about the entire commodities market. Once the manipulation was exposed, many investors found it challenging to trust not only the silver market, but also other investments. This breakdown of trust can ultimately deter participation in markets, reduce liquidity, and increase volatility, posing significant risks to both individual and institutional investors. A transparent, fair market is crucial for fostering investment confidence and long-term capital growth. Unexpected regulatory responses can emerge to address perceived manipulation. Unforeseen regulatory actions often follow allegations of market manipulation as authorities strive to maintain market integrity. The events surrounding Silver Thursday are a prime example of how swiftly regulations can change in response to manipulative behaviors. The Commodity Futures Trading Commission intervened by altering trading rules that day, which precipitated the collapse in silver prices. Such regulatory responses are crafted to protect the interests of the broader market and investor populations, rather than just penalizing the offenders. This foreshadows the reality that when markets are viewed as being tampered with, swift and sometimes harsh regulatory measures can ensue, thereby altering the trading landscape permanently. Thus, understanding the regulatory environment is essential for any entrepreneur or investor engaging in markets. Financial losses from manipulation can be staggering, as shown by the Hunts. The financial repercussions of market manipulation can be devastating, as illustrated by the Hunt brothers' dramatic losses. After driving silver prices to unprecedented heights, their inability to sustain this artificial market led to catastrophic financial fallout. On Silver Thursday, the Hunts lost over $1 billion in a matter of hours, showcasing the immense risks involved in attempting to manipulate commodities. This loss was not just a financial blow. It also had far-reaching implications for their reputation, business operations, and future investments. The lesson here is clear. The potential for enormous financial loss serves as a cautionary tale for aspiring entrepreneurs and investors alike. The costs of unethical practices can far outweigh any temporary gains achieved through manipulation. The importance of ethical practices in maintaining market integrity. Ethical practices are paramount for sustaining market integrity and ensuring that all participants have fair opportunities. The Hunt brothers' experience serves as a reminder that, in the long run, honorably trading is more beneficial than engaging in manipulative tactics. By adhering to ethical standards, participants contribute to the stability of markets and enhance investor confidence. Trust built through integrity fosters a more inclusive and robust investment environment, encouraging participation from a wider array of investors. Moreover, markets grounded in ethical behavior experience less volatility and are more resilient to shocks. Establishing a reputation for ethical practices can be a competitive advantage for entrepreneurs in today's interconnected financial world. The impact of regulation on markets. Regulations are designed to maintain fairness in markets. This section explores how changes in regulation can dramatically alter the course of investment strategies. Regulatory bodies can change rules in response to market anomalies. Regulatory bodies play a critical role in overseeing financial markets to ensure integrity and fairness. When anomalies occur, as seen during the Hunt brothers' silver speculation, regulators may implement swift changes to the rules governing trading activities. This is to mitigate excessive risk-taking and protect the broader economy from destabilization. In the case of Silver Thursday, regulators introduced restrictions to curb the Hunt's ability to dominate the silver market. This intervention serves as a stark reminder that regulatory frameworks can shift dramatically, especially when irregularities threaten market stability. Such changes can alter the expectations and strategies of investors significantly. As they navigate the tumultuous waters of finance, investors must remain aware of the potential for sudden regulatory adjustments. This understanding is crucial for developing responsive and flexible investment strategies that can withstand external pressures. Understanding regulations is crucial for navigating investment risks. An in-depth comprehension of market regulations is essential for any investor aiming to minimize risks. Regulations dictate how markets operate, the permissible actions of traders, and the consequences of violations. For investors, especially in volatile environments like commodity trading, ignorance of these rules can lead to significant financial losses. The Hunt brothers experienced firsthand how regulation impacts market dynamics. Their extensive silver purchases were initially seen as strategic, however. The regulatory response to their actions drastically reversed their fortunes. Investors must familiarize themselves with existing laws and anticipate potential changes to protect their interests effectively. By proactively engaging with the regulatory landscape, investors can make informed decisions and adjust their strategies accordingly, thus safeguarding their investments against unforeseen shifts in the market. Investors should stay informed about potential regulatory changes affecting their strategies. In a rapidly evolving financial landscape, staying informed about regulatory changes is crucial for any investor. Financial environments can shift due to economic pressures, political considerations, or public sentiment, all triggering new regulations. The Hunt brothers' attempt to corner the silver market exemplified the consequences of being blindsided by regulatory actions. Investors can mitigate risks by actively monitoring regulatory developments and participating in discussions about market governance. This vigilance allows for timely adjustments to trading strategies, reducing the potential for losses stemming from sudden regulatory shifts. Subscribing to industry news, attending relevant seminars, and engaging with professional advisors can provide investors with vital insights into upcoming regulations. In essence, informed investors can adapt quickly, ensuring a resilient investment approach in the face of change. Compliance is essential for long-term success in finance. Compliance is not merely a regulatory obligation, it is a fundamental component of sustainable success in finance. Ensuring adherence to regulations protects investors from penalties and legal repercussions and cultivates a reputation of trustworthiness in the market. As illustrated by the fallout from the Hunt brothers' actions, neglecting compliance can lead to disastrous consequences. For entrepreneurs, establishing a compliance-oriented culture within their organizations can foster long-term resilience. This involves training teams on relevant regulations, conducting regular audits, and adapting business practices as laws evolve. The financial world is fraught with uncertainties, and companies that prioritize compliance are better positioned to navigate challenges successfully. In conclusion, a commitment to compliance not only shields businesses from regulatory risks, but also enhances their credibility and attractiveness to investors. The story of the Hunt brothers serves as a cautionary tale that underscores the value of integrating compliance into the core strategy of any financial endeavor. Reflections on the silver squeeze, lessons for a new generation. The journey through the highs and lows of the Hunt brothers and their audacious venture into the silver market illuminates profound truths about ambition, risk, and the rules that govern financial markets. Their story is not just a historical account, is a timeless reminder of how the intertwining forces of greed, speculation, and regulation can shape destiny. As you close this chapter, reflect on the lessons learned from the Hunts. Leap into the world of commodities. In a rapidly changing financial landscape, the importance of understanding market dynamics cannot be overstated. Know that although ambition drives progress, self-awareness and disciplined strategy should guide your pursuits. Their downfall exemplifies the dangers of leveraging enthusiasm without caution, emphasizing the value of a balanced approach to investment that prioritizes long-term vision over short-term gains. Consider each step forward carefully, building a strategy grounded in sustainable practices. The silver squeeze transformed not only the market landscape, but also our understanding of market manipulation and its repercussions. Future entrepreneurs should embrace these lessons, armed with the knowledge of how regulatory frameworks can change swiftly in response to market dynamics. In your own journey, let the legacy of the Hunts empower you to tread thoughtfully in the realm of finance. Explore boldly, but do so with mindfulness, knowing that every decision contributes to the larger narrative of your financial future. Here's to your pursuit of success, guided by the wisdom gleaned from the past. The allure of silver, understanding the Hunt brothers' motivation. The Hunt brothers' venture into the silver market was fueled by more than just financial gain. Their motivations were complex and deeply rooted in the socio-economic context of their time. Understanding these drivers is crucial to grasping the full story of the silver squeeze. 1. Fear of inflation. In the late 1970s, rampant inflation was a significant concern for many Americans, including the Hunt brothers. As inflation rates soared, the purchasing power of the dollar dramatically declined, leading individuals and investors to seek refuge in tangible assets. Silver, seen as a reliable store of value, emerged as a popular choice. This environment created a perfect storm for the Hunts, who feared that the traditional financial markets would fail to shield them from the impending economic instability. The brothers believed that investing heavily in silver could not only protect their wealth, but also position them to take advantage of rising prices. Their concerns were well-founded. During this period, consumer prices were increasing at alarming rates, prompting a shift in investment strategies. The Hunt strategy was heavily influenced by their conviction that gold and silver, as precious metals, would serve as both a buffer against inflation and a hedge against the potential collapse of the dollar. 2. Wealth preservation. As prominent oil tycoons, Nelson Bunker Hunt and William Herbert Hunt understood the volatility of their primary industry and sought to diversify their fortune. The Hunts saw silver not merely as an investment opportunity, but as a fundamental part of wealth preservation amid uncertain economic times. By moving beyond oil, they aimed to secure their financial legacy for future generations. The brothers perceived silver as an asset with intrinsic value that could withstand economic fluctuations. Their intent was not just to accumulate wealth, but to ensure its sustainability in the face of potential downturns. This desire to safeguard their fortune influenced their decision-making processes and ultimately propelled them into the aggressive silver market, where they sought to control a significant share of the world's supply. 3. Public sentiment. During the late 1970s, there was a notable shift in public perception toward precious metals, particularly in reaction to economic uncertainties. The Hunt brothers capitalized on this growing interest, recognizing that increased demand from both individuals and institutions could assist in driving silver prices higher. They believed that by amassing large quantities of silver, they could influence its market and profitability. The Hunts understood that public sentiment could fuel speculative new trends in commodity trading, effectively creating a self-fulfilling prophecy. The boom in popularity surrounding gold and silver was not just a fleeting trend. It was a movement spurred by economic fear and desire for stability. This keen awareness allowed the Hunts to predict market movements, further motivating their aggressive accumulation strategy. 4. The American dream. Deeply rooted in their Texas heritage, the Hunt brothers exemplified a vision of the American dream characterized by ambition, entrepreneurial spirit, and a relentless pursuit of success. They viewed their foray into the silver market not merely as an investment, but as a bold expression of their belief in maximizing potential. Their actions represented more than just financial ambition. They aligned with a broader ethos of optimism and determination prevalent in American culture during that era. This conviction motivated them to take risks that many might consider reckless. The Hunts' alignment of financial ambition with a sense of national pride showcased their desire to make a mark, to leave a legacy that would reflect their values and aspirations. By pursuing the silver market, they hoped not only to enrich themselves, but also to embody a belief in the ability to overcome challenges through hard work and strategy. Market manipulation, the strategies behind the squeeze. The Hunt brothers employed various strategies to corner the silver market, but these tactics transformed their ambition into manipulation. Understanding these methods offers valuable lessons on the ethical lines of investment. 1. Accumulation strategy. The Hunt brothers employed a highly calculated accumulation strategy, wherein they strategically purchased vast quantities of silver over a relatively short period. This approach effectively reduced the metal's availability in the market, creating a ripple effect throughout the commodity trading ecosystem. By assembling such substantial silver reserves, they catalyzed perceptions of scarcity among traders and investors. This perception began to drive prices upwards. As availability dwindled, their commitment to acquiring silver was not merely about wealth accumulation, it was also a hedge against anticipated inflation and currency devaluation, factors they believed would destabilize the broader economy. The Hunts' stronghold on the silver market was a manifestation of their ambition to assert control over a vital commodity. 2. Use of leverage. The Hunts' ambitions were partially financed through aggressive leverage, allowing them to amplify their purchasing power but concomitantly increasing their risk exposure. They borrowed significant sums of money to fund their silver acquisitions, operating under the belief that silver prices would continue to rise. This strategy of using borrowed funds is a double-edged sword. While it can lead to enormous gains when the market performs well, it can likewise magnify losses. As the price of silver surged, the Hunts appeared to have made wise investments, but their leveraged positions meant that even a minor correction could lead to catastrophic financial consequences. This reliance on debt illustrated the precarious nature of their speculative venture, serving as a cautionary tale about risky financial strategies. 3. Creating a silver scarcity. One of the most impactful tactics the Hunts employed was the physical hoarding of silver, which they did to create an artificial scarcity in the market. By withholding a substantial quantity of silver from market circulation, they effectively manipulated supply dynamics. This tactic exerted upward pressure on silver prices, propelling them to record levels as demand continued amidst a perceived shortage. However, this approach raised ethical questions about market manipulation. The illusion of scarcity not only inflated prices, but also misled other investors, who were unaware of the extent to which the Hunts had influenced the market. This stark example highlights the fine line between market strategies and unethical manipulation, serving as an important lesson for aspiring entrepreneurs. 4. Impact on market psychology. The Hunts' ambitious tactics directly impacted market psychology, triggering a surge of speculative buying among investors who sensed the rising tides of silver prices. As prices escalated, more market participants rushed to invest, driven by the fear of missing out on what seemed like a golden opportunity. This reaction intensified the Hunts' manipulation of the market, further inflating silver prices and increasing volatility. The behavior observed during this period illustrates how a few aggressive players can shift the dynamics of an entire market, affecting wider investment behaviors. This case serves as a vital lesson for future entrepreneurs on the psychological aspects of trading and the importance of understanding investor sentiment in commodity markets. The role of regulation in the Hunt brothers' collapse. The events leading to Silver Thursday highlight how regulatory changes can swiftly alter the landscape of financial markets. This turn of events serves as a stark reminder of the importance of compliance in investments. 1. Regulatory changes. On Silver Thursday, March 27, 1980, the landscape of the silver market shifted dramatically due to regulatory changes imposed by the Commodities Futures Trading Commission. These new rules were designed to curb excessive speculation and prevent market manipulation, impacting the Hunts' ability to maintain their aggressive strategy of accumulating silver. The CFTC's adjustments effectively restricted the number of contracts that could be held over the counter, aiming to control the rampant increase in silver prices driven by the Hunt brothers' fervent purchases. This sudden regulatory intervention caught the Hunts off guard, as it limited their scope for maneuverability in a market they had been dominating. The change in rules underscored the volatility inherent in commodity trading and highlighted the critical role that regulation plays in maintaining market stability. Investors and entrepreneurs should be aware that regulatory environments are subject to change, often in response to extreme market conditions, thus requiring constant vigilance to adapt and respond effectively. 2. Margin requirements. The adjustments in margin requirements played a pivotal role in exacerbating the Hunts' downfall. As the price of silver soared, the CFTC increased the margin requirements, demanding more capital to maintain existing positions. For the Hunt brothers, this shift meant that they had to liquidate a significant portion of their holdings to meet the new demands. Consequently, the forced selling of their substantial silver stockpile triggered a dramatic decline in prices. This scenario illustrates a critical lesson for any entrepreneur involved in commodity trading. Leverage can be a double-edged sword. While initially it can amplify gains, it can also amplify losses when market dynamics shift. Understanding margin requirements and how they influence personal and market liquidity is essential in managing risk and ensuring financial resilience in volatile markets. 3. Government intervention. The events surrounding Silver Thursday drew significant government attention, reflecting the power of regulatory bodies to intervene in private markets. The government's actions aimed at stabilizing the silver market were indicative of its commitment to protecting the integrity of financial systems against catastrophic failure. This intervention reinforced the notion that even in free markets, external forces have the capacity to influence outcomes drastically. The response of the authorities serves as a reminder to entrepreneurs that they must be prepared for government actions that can unexpectedly alter market conditions. Regulatory agencies are empowered to intervene when they perceive threats to economic stability, thus requiring investors to maintain compliance and adaptability in their strategies. Adequate awareness of the regulatory landscape can significantly impact investment decisions and outcomes. 4. Lessons on compliance. In light of the Hunt brothers' experience, entrepreneurs must prioritize regulatory compliance to safeguard their ventures from abrupt market shifts. The collapse that resulted from changes in trading rules illustrates how even the most ambitious plans can be undermined by unforeseen regulatory actions. Understanding the regulatory environment is not just about avoiding fines, it is essential for sustainable business practices and protecting investments. Entrepreneurs should develop a proactive approach to regulatory awareness, incorporating compliance into their strategic planning and risk assessment processes. This commitment lays the groundwork for navigating complex market landscapes and helps avoid pitfalls associated with ignorance of the rules governing market behavior. In an era of fast-paced financial evolution, staying informed about regulatory issues is not just prudent, it is critical for long-term success. The aftermath consequences of the silver squeeze. The aftermath of the Hunt brothers' foray into silver trading extended far beyond their financial loss. The event reshaped market perceptions and investor behavior significantly, offering vital insights for future entrepreneurs. 1. Financial ruin. The fallout from the Hunt brothers' silver trading escapade was nothing short of catastrophic. The Hunts, once mighty and revered figures in the financial world, experienced a rapid decline in their fortunes. By losing billions on March 27, 1980, also known as Silver Thursday, their financial empire began to crumble. This dramatic loss not only negated years of wealth accumulation, but also tarnished their reputation within elite financial circles. As word spread about their failure, the brothers' connections and influence waned. The immediate repercussions meant not just loss of wealth, but also a significant blow to their credibility as financial moguls. This shift highlighted the precarious nature of extreme speculation, signaling to both investors and entrepreneurs that unchecked ambition can lead to devastating consequences. 2. Market volatility. The events surrounding the silver squeeze triggered unprecedented volatility in the silver market. Following the Hunt brothers' collapse, silver prices fluctuated wildly, creating a chaotic environment for traders and consumers alike. This instability was fueled by uncertainty as market participants reevaluated their positions and strategies in light of the Hunt's failure. As silver prices dipped dramatically, it impacted not only futures traders, but also industrial consumers who relied on silver for various applications. Buyers became hesitant, which further contributed to heightened market fluctuations. The long-term effects of this crisis introduced a cautionary sentiment towards commodities trading, compelling both short-term speculators and long-term investors to reconsider their approaches to market engagement. 3. Repercussions for speculators. The disastrous outcome of the Hunt brothers' silver gambit served as a cautionary tale for speculators worldwide. Many traders were left with a stark realization: leveraging in high-stakes trading involves inherent risks that can lead to financial ruin. The lesson was clear: ambition should be tempered with prudence and realistic assessments of market dynamics. This event led to an increased emphasis on risk management strategies among traders and investors alike. Many began to explore diversified portfolios and defensive trading practices as viable alternatives to the aggressive strategies that had dominated before. In essence, the silver squeeze reinforced the importance of understanding one's risk tolerance and the potential ramifications of market manipulation. 4. Long-term market changes. In the wake of the silver squeeze, significant shifts occurred within the financial landscape. The market response to the Hunt brothers' drastic failure prompted a more cautious approach to investing across commodities and wider financial markets. Investors began to prioritize strategies that emphasized sustainability over rapid gains, leading to changes in how commodities were traded. Regulatory bodies also took notice, implementing tighter controls to prevent similar market manipulation scenarios in the future. These changes not only influenced trading practices, but also laid the groundwork for enhanced transparency within financial systems. Ultimately, the long-term effects of the hunts, one-time glory turned cautionary tale, echoed throughout the industry, instilling a culture of vigilance and strategic restraint. Final thoughts, lessons for future entrepreneurs. The story of the Hunt brothers provides crucial lessons for today's entrepreneurs navigating the finance world. As markets evolve, reflecting on the past can guide future strategies and decision-making. 1. Balance ambition with caution. Entrepreneurship thrives on ambition, yet unbridled enthusiasm can lead to dire consequences. The Hunt brothers' attempt to corner the silver market exemplifies how unchecked ambition can result in catastrophic financial downfall. While aiming for high rewards is essential, it is equally important to implement grounded strategies to mitigate risks associated with overreaching. A measured approach involves recognizing potential pitfalls while pursuing ambitious goals. Entrepreneurs should develop plans that integrate realistic expectations and risk assessments. This balance allows for innovative solutions without surrendering to reckless decisions. Moreover, staying cautious in turbulent markets can provide a competitive edge, maintaining stability while others falter. Ultimately, cultivating a disciplined mindset alongside your ambition is critical. By carefully weighing the risks and rewards, you position yourself for sustainable growth, avoiding the traps that led to the Hunt's downfall in their quest for silver supremacy. 2. Understand market dynamics. Grasping the complexities of market forces is vital for entrepreneurs venturing into finance. The Hunt brothers' experience serves as a stark reminder of how market volatility can drastically impact strategy. A deep understanding of supply and demand, consumer behavior, and external economic factors empowers entrepreneurs to navigate through unpredictable market conditions effectively. By analyzing historical trends and current events, entrepreneurs can anticipate shifts and adapt their strategies accordingly. Market dynamics often include regulatory changes, tech advancements, and emerging competitors, all of which require attentive observation. Knowledge of these elements fosters informed decision-making, enabling you to seize opportunities while managing risks. In essence, investing time and resources to truly understand market dynamics is a cornerstone of entrepreneurial success. This acumen not only prepares you for challenges, but also positions you for long-term viability and growth in a highly competitive financial landscape. 3. Foster ethical investment practices. Maintaining ethical standards in investment practices is crucial in avoiding the pitfalls of market manipulation and regulatory backlash. The Hunt brothers' aggressive strategies to corner the silver market raised ethical questions and alarmed regulators, leading to their undoing. Entrepreneurs must foster a culture of integrity, ensuring that their practices align with both ethical considerations and legal frameworks. By prioritizing transparency and accountability, entrepreneurs can build trust with stakeholders, including investors, clients, and regulatory bodies. Emphasizing ethical investment creates a solid foundation for long-term success, allowing businesses to thrive without compromising their values. Additionally, aligning investment practices with societal and environmental goals can enhance reputations and attract a conscientious customer base. 4. Stay prepared for changes. In today's fast-paced financial world, adaptability is essential for enduring success. The Hunt's dramatic downfall on Silver Thursday highlights the risks of being unprepared for sudden regulatory changes that can reshape market landscapes. Entrepreneurs must stay alert and not only anticipate potential shifts, but also establish frameworks that allow for quick responses to such alterations. Building a flexible business model enables you to pivot strategies as needed, ensuring resilience in the face of unforeseeable market disruptions. This preparation might involve continuous learning, relationship building, and scenario planning that collectively strengthen a business's foundation. Moreover, engaging with regulatory trends and actively communicating with industry experts can provide valuable insights. In an environment where rules can change overnight, staying prepared is not just advantageous, but a necessity. Embrace this mindset and position your venture to thrive, regardless of what challenges may arise. The Silver Squeeze: How Two Oil Billionaires Tried to Buy All the Silver in the World.